All right. Good morning, people. Let's see what's going on. It's a nice setup this morning. Guys, jump in right here. This morning, jumping right here, 5. Sell all the way up here. When the market all down, start go down, waiting right here. Wait and see right there. You see the buyer step in, waiting. When this one volume pick up, you jump in right here. 460. And take profit right here, guys. Alright, if this one break right here, 625, you buy back. If you're wrong, you get out down here, you buy up here. That's all. Just do that all day long. See more plus? I told you. Look at all this before it happened. It's happened all the time. That's classic. Classic guy. Classic. Happened all day long. Here what I trade 2 stock, 50% win rate. This one I jump in 9, I get out 7 something right here. $8. Lost $1.20, 100 share, 150 share, $200 right there. With a good trade. I'm learning good. Right here, SIP. Let's see SIP right here, look. Good trade, guy. You jump here, market open, jump real fast. Hold right here, $8. Break 8, I'm out right here. QURE, crazy guy, QURE. This one can run too. Look at this guy, QURE, up 200% today. This couple of days I checked already, look, from $14, 14, up almost, right there guy, crazy, QURE. The market is crazy guy. I see that? Up almost 200%. Look this one. Quantum computer, guy. Quantum computer, very hot lately. A lot of money to be made. Look, you go higher, huh? Break out right there. You see that? Oh man, look at this one, break out too. You see right there, I told you 14, pull back, break out 14. Man. Look at quantum. Never die. This one break out right now. Look at this. Start to curve back up right now. This one can go from $15. 15 resistant guy. Right there, 15. Break 14 right now. Hold on 14. This stuff can squeeze. A lot short on this one. I jumping too early this day right here. I'm out right here this yesterday. Look here, ball plot, the one over there. Let's see, it hold right here. It power line, it break right here. You can jump back in. Okay. And this guy right here. Happened all day long, guy. All day long, I told you guys. 14, try to break 14, 14. This yesterday, pump to 14, stuck right there, pull back. Build ball plus. Break, go to 15, question mark. Right here, under 14, get out. That's it. Under 14, get out. This one is monster, this one right here. 2 days ago, I paid $7, this one. And I jumped out yesterday right here and look at it. Right now, 71 cents. Crazy, guys. Everything can happen. Look at it. How can it happen, guys? How can it happen? Look at that, guy. You sell your whole house right there if you don't stop out. Great, huh? This morning I tried to buy a couple shares for fun, $1. Still $1, not working. I tried to buy some right here, $1. And then 94, I'm out. Small size. Couple dollars for fun. See how low can it go. See, learning. Right here. This one is right here, guys. I get in right here, what? Crazy, huh? Right here, guys. Where is that? Right here. In $99, get out 95. Cannot move. Get out. Try to buy the dip. Doesn't work. When it go down, go down. I jump in right here. This candle before market open. Get out right here. Right here. Have to get out. That's crazy, guy. Let's check out this one. Crazy, get up. What the deal? The deal right here. Okay. DJ core price target maintain with the $70 a share by somebody upgrade, that's all. Crazy. Somebody upgrade. Nothing special. Just 4 hours ago. If this one down here, you short it. Crazy guy. Can you short underneath here? 35 and the 35, short it. Open price, maybe. Look here, Nvidia started to go down. Nvidia. Right here, resistant. Look at red, the chart say anything, guys. The chart say everything. Look at daily chart, okay? Look at daily. You see daily chart resistant right here. 185. Every everything. Let's try to short right there. The million ball flat break 85, go to $200. Break 85, go to $200. Crazy. All down right now. $1 is nothing. Peanut. Really peanut. Palantir, see? Palantir do the same thing. 180. Palantir 188. Resistant. Everything started going down now. QQQ. Market go down, get out. QQQ break out. SQQQ, short SQQQ. This one under pump right there, crazy guy. You can make $100 here, $100 there, using the system. This one right here, let's see. See, when I draw a line still downtrend, look at that guy, look at the line. Do I have the line? Yeah, I know that. Waiting for power lunch, that's all. If this one break 125 again, 525 again, be careful on that power lunch. Watch out the volume. Watch out the volume, that's all. Watch out the volume. Watch out the volume. Watch out the volume, okay. SQQQ.
How's it going?
First day, so
Sometimes, Next.
try again.
you could have done better.
When I think back on my years in the market, the wins, the losses, the hard lessons bought with real dollars, I keep circling around the same idea. The markets don't forgive sloppy thinking. They don't reward guesswork. They don't care what you or I want. They move as they move. And it's the trader's task to read them clean, without confusion, without noise. That's why I said in the previous video on trading with clarity that a man must be able to see the tape for what it is and not what he wishes it to be. Today, I want to go one step further. I want to share the 3 golden questions I learned to ask myself before entering any trade. They are simple to state, but they aren't easy to live by. And you sitting there, listening, let me ask you, do you really pause before hitting that buy or sell button? Or do you rush in on a feeling? You see, most people in the market treat trading like a roulette wheel. They spin, they hope, they pray. That's not trading. That's gambling. And the market, unlike a casino, doesn't hand out free drinks while you wait for your luck to turn. The market takes relentlessly from the careless. Now, I'm not saying this to scare you. I'm saying it because I've been that man, eager, impulsive, hungry to prove myself right. And it cost me. It always costs. So these 3 questions I'll share, they're not theory, they're survival tools. They're the difference between being broken by the game and learning to play it with discipline. The first question I always ask is the trend clear? Doesn't matter what stock, what commodity, what index, you have to see the general drift of prices. Is it up? Is it down? Or is it sideways? And don't tell me you don't know, because if you can't tell, you shouldn't trade it. That's the truth. Would you step into a boxing ring blindfolded? Then why would you step into a market you can't read? I once bought stocks simply because they looked cheap compared to last month. What a fool's errand. Prices don't care about last month. They care about today and tomorrow. The market doesn't move because you think something is undervalued. It moves because supply and demand say it moves. Clear trend, that's the first key. But the second golden question runs deeper. Am I ready to lose? You might not like the sound of that. You want me to talk about profits, don't you? About winning trades. But profits are the result, not the plan. Risk, that's the plan. If you can't accept loss, you'll never last in this game. I've seen men with fortunes crumble because they refused to cut a loss. They told themselves, it'll come back. Do you ever whisper that to yourself? It'll come back. That phrase has ruined more traders than any bear market. Before you trade, you ask, how much am I willing to lose on this idea? And you fix it in your mind. If the market proves you wrong, you don't argue, you don't beg, you get out, fast. And then comes the third golden question, is this trade enough my capital? That's the one most overlooked. You might spot a good trend, you might even fix your risk. But if the size of the trade is too heavy for your account, you're still courting ruin. A single mistake can wipe out weeks of careful work. That's not trading smart. That's greed in disguise. When I was young, I used to bet too big because I wanted to get rich quick. I thought I was smarter than the tape. But the tape is never wrong, only traders are. So I learned to always scale your trade to your capital.
The State Farm Personal Price Plan helps you create an affordable price just for you.
Call State Farm agent Derek Sue for your personal price plan today.
Protect your bankroll, because the only thing that lets you play again tomorrow is the money you didn't lose today. Now, stop a second and think with me. How many times did you lose not because the idea was wrong, but because your position was too big? Didn't the market nudge you out on a tiny dip, only to run in your direction afterward? That's not bad luck. That's bad sizing. A trader with discipline scales correctly, so he can stay in the game long enough to be right. You see, these 3 golden questions: trend, risk, capital, they aren't rules you follow once in a while. They must be carved into your trading habit, etched so deep you don't dare forget them. Because in trading, forgetting is fatal. Think about it, how many times have you told yourself, just this once, I'll ignore my stop, or this one looks too good, I'll double up. And how did that end? I know how it ends. I've lived it. The truth is, the hardest part of trading isn't finding opportunities. The tape gives you endless opportunities. The hardest part is disciplining your own impulses. That's why I keep talking about mindset. Because a trader's wealth doesn't come from a magic indicator or a secret formula. It comes from building the right habits, the right questions, the right mental posture. Wealth in the market is not the money you grab in a lucky run, it's the money you protect and compound over years. Ask yourself this: what good is making 10,000 on a hot trade if you give back 12 the next week? That's not wealth building. That's just spinning your wheels. Wealth comes when you guard the downside with everything you've got, and let the upside take care of itself. That's why I keep hammering risk. I don't care how sure you feel, the market doesn't pay out for feeling. It pays out for patience, for discipline, for clarity. And remember how in that video on trading with clarity, I told you a man must cut through noise like a surgeon's knife. These golden questions are the knife. They strip away the illusion and leave only the facts. What's the trend? What's the risk? Does this trade fit your capital? Let me tell you something about emotions, because they're the enemy of clear judgment. When you watch a stock run up without you, do you feel that itch? That rush of envy, like you're missing the party? That's the market testing your nerve. And when you finally jump in late, isn't it true that's the moment it turns on you? I've chased like that. We all have. But every time, it teaches the same lesson. If the trade doesn't line up with the 3 golden questions, let it go. Better to miss a profit than to catch a loss. And fear is just as dangerous as greed. You see prices dip a little, you panic, you sell, and then the market rebounds. Fear makes you break your own plan. That's why you must settle the questions before you enter. If you know the trend, if you know the risk, if your size is right, then you can sit still. You don't fidget at every tick. You don't torture yourself with second guessing. You let the market do its work. Because a trader must sometimes sit like a statue motionless, but not careless waiting for the tape to prove him right or prove him wrong. Do you see how these questions protect you from yourself? That's the real secret. Trading isn't about outsmarting the market. It's about outsmarting your own weaknesses. The market will always be bigger, faster, stronger than you. But you can control you. That's the battlefield you fight on. And when you learn to master yourself, the profits take care of themselves. I'll tell you another truth. Most fortunes lost in the market aren't lost because the man couldn't pick a direction. They're lost because he couldn't control his size or his patience. He let a small loss grow too big. He let a winning position get cut short. He violated his own rules because of excitement, fear, or stubbornness. You ever hold on just to prove you're right? That's ego trading your account. Ego doesn't build wealth. Ego destroys it. I remember a cotton trade early in my career. The tape was clear, the trend was down. But I convinced myself I knew better. I thought the decline was overdone. I bought heavy, and when the price kept sinking, I told myself it would bounce. It didn't. It buried me. That was tuition paid to the market. Expensive tuition. But it taught me the second golden question. Always decide in advance what you're willing to lose. Never argue with the tape. The tape has no emotions, only you do.
For most people, risk means danger and uncertainty. For me, it means opportunity. Risk is a constant. It's something to embrace and manage. It takes focus, resilience, and discipline. When the pressure is on, I feel right at home. How do you manage risk?
CB Group, where risk meets opportunity.
For people with eosinophilic esophagitis or EOE, to treat your EOE,
Or just deal with symptoms.
Dupixent is a breakthrough treatment proven to help reduce inflammation in the esophagus and improve swallowing.
Severe allergic reactions, including skin reactions, can occur. Get help right away if you have trouble breathing or wheezing or swelling of your face, mouth, tongue, or throat. Tell your doctor of new or worsening joint aches and pain or a parasitic infection or asthma. Don't change or stop other treatments without talking to your doctor.
Talk to your EOE specialist about Dupixent.
Now let me ask you this. Do you have your questions written down? Or do you just keep them in your head? I'll tell you, a written rule is 10 times stronger than a spoken one. Write them, post them, drill them into your process. Because when the market starts running and your blood starts rushing, your memory gets fuzzy. You forget. But if your rules are right in front of you, they pull you back. They remind you of the cost of breaking discipline. And don't fool yourself thinking you can skip the questions once you get good. I've traded for decades, made and lost fortunes, and I still ask myself before every trade, what's the trend, what's my risk, and is this size in line with my capital? It never gets old, because the market never stops testing you. The moment you think you've graduated beyond the basics, that's the moment the market humbles you. When a man sits before the market, the very first and most important thing he must do is to determine the trend. That is the cornerstone of all trading, and it is where so many people go astray. The average trader is impatient. He sees prices moving and he feels he must be in on the action right now. But what is he really acting upon? Is it a clear signal of direction, or is it merely the noise of the tape? That's the question most don't pause to answer. And I'll tell you, the tape is filled with noise, false starts, small rallies, minor dips, moves that mean nothing in the larger scheme. If you mistake those for real direction, you'll find yourself whipped in and out of trades until your capital is gone and your confidence shattered. Let me ask you directly, do you really study the broad drift before you step in, or are you lured by the twitch of the last 5-minute bar? Trend is the heartbeat of the market. It's the river's current. And you, as a trader, are nothing but a boat on that river. You can row, you can steer, but you cannot fight the current. If you try, you'll exhaust yourself and sink. That's why I learned long ago, it is safer and surer to align yourself with the dominant trend than to think you can call the turn. Many beginners love to pick tops and bottoms. They dream of catching the exact reversal point, of buying at the lowest tick or selling at the highest tick. It's a romantic idea. But it's also the surest way to lose. The market doesn't pay for romance. It pays for discipline. When I ask, is the trend clear? I mean just that. Not do I hope the trend is up. Not does this stock look cheap compared to last year. But is the tape showing, without question, that buyers or sellers are in command? Because when control is clear, the path is smoother. A strong uptrend carries weak hands with it, lifting prices despite their hesitation. A strong downtrend crushes the hopeful, no matter how stubbornly they cling. The clarity of trend removes the guesswork. And isn't that what you want to trade with certainty instead of hope? I've watched thousands of men ignore this simple question. They buy in a dull market, telling themselves it's about to break out. They sell in a strong uptrend, convinced it's too high. They make moves against the tape, all because they think they see something others don't.
They don't see the thing.
The tape sees more than you or I ever could. The tape is the sum of every buyer and seller in the market, the collective mind expressed in price. To stand against it is like trying to hold back the tide with your bare hands. Have you ever tried it? Have you ever shorted a rising stock simply because you felt it had to come down?
Look at wait and see right here, okay? All the way
The clearer the trend, the less cleverness you need. And that is a blessing, because cleverness is costly in markets. Men who try to outsmart the tape usually pay with real money for their education. But a man who simply aligns with the obvious flow, who admits the tape is stronger than
cannot break
he
720.
keeps his account intact. He may not boast of buying the exact bottom or selling the exact top, but he builds his stakes steadily, because he only plays when the odds are playing. When I studied price charts as a young man, I noticed something that seemed almost too simple. Stocks that were going up kept going up. Stocks that were going down kept going down.
Yes.
Not forever, of course, but long enough to make a man money if he was willing to ride them. And yet, instead of believing what was in front of their eyes, most traders insisted on complicating it. They drew lines, they invented reasons, they whispered tips. I ignored their chatter and watched the movement. Price itself was the truth. If it moved higher day after day, there was demand. If it sank lower day after day, there was supply. My job was not to argue, but to recognize and act. Now don't misunderstand me. Seeing trend is not about staring at one candle or one day's bar.
Okay, S1 cannot break $2, guys.
They see a
Look at
one-day
here.
rally in a
S1.
declining market and call it a reversal.
$2.
They see a one-day drop in a rising trend and panic.
See that? Fake breakout,
These
move all the way
sequences,
down.
Not in isolated moves. You must step back, widen your view and ask,
Okay,
is
3
this the
days ago,
market's
look at
general
7 days.
direction,
Look,
or just a
$2.
ripple against the current? If the
Cannot
river is
break
flowing
two.
downstream, a small wave upstream doesn't change that. The wise trader knows the difference. Think of the money mindset that lies underneath this. When you insist on fighting the trend, it comes from ego. You want to be the man who is right against the crowd. You want to prove
Crazy,
your
huh?
brilliance.
Look at that.
But what good is brilliance if your account
Alright.
shrinks? Wealth in trading doesn't come from being right in theory. It comes from being right in practice.
This last week, this one,
Following the line of
never
the
died, guys. Look at this one.
Why should you wrestle with the market when it already shows you where it wants
From
to go?
$10 go to all the way
Most traders
to
forget
300.
Saves
Look
you
at it,
from overtrade.
300.
When the market is
Right now, hold right here, not going down.
directionless, what does a disciplined
Look,
man do?
right there.
He sits, he waits, he does nothing.
Let me show you.
But the restless trader,
You don't
the
believe
one
that,
who
huh?
does not accept
Look at it.
patience, he
that
forces
300?
trades where there is no trend, and each force
Right
trade
here.
costs him
This
a little more
30-minute
blood.
chart.
Ask yourself how many of your
At that time, I get in right here, I get out
because you felt you had to
40
be doing something.
and break 150 all the way, guys. Look
Unclear.
at
The
150
best
all the way.
trade is no trade. That's as much a part of asking the golden question as spotting an obvious up or down drift. Let me give you a picture. Imagine
Right now,
you're standing on a train track.
120. Let's see what's
In the
going on.
distance, you see a train
Crazy,
coming,
and not going
steam
down.
billowing, wheels grinding. Would you step in front of it just because you think it's gone too far already? That's exactly what a man does when he sells short in a roaring uptrend. Or picture the opposite. The train is hurtling downhill, rattling at full speed, and you try to stop it with your bare hands by buying against it. Foolish. The only sensible thing is to step aside, or, better yet, ride the train in the direction it's already going. That is the essence of trend following. And yet, I'll ask you again, do you always trade with the trend? Or do you sometimes slip, telling yourself this time it's different? Every time I let myself believe I was smarter than the tape taught me a costly lesson. Every time I humbled myself to follow the clear current, I preserved both my money and my nerve. This is why I say the first golden question is the most important of all. Because if you cannot answer it with certainty, the other two questions about risk and capital become meaningless. They are secondary to the direction of the market. Risk management protects you once you are in a trade, but it is the clarity of trend that determines whether you should be in at all. A soldier doesn't march into battle without knowing which side holds the field. Why should a trader march into the market without knowing which side the bulls or the bears has the upper hand? Clarity in trend is also what lets you build confidence. Not the false confidence of blind gambling, but the steady confidence that comes from aligning with visible strength. When you know the trend is up,
Look,
and you
this
are
one can
wrong,
move.
you can
Look
sit
right
back.
there, guys.
You don't twitch at every tick. You don't jump out of the first pullback. You let the position breathe because you trust the current. Likewise, when you know the trend is down,
Dump,
you
dump,
are
dump,
sure.
dump, dump.
You don't
Crazy.
fear a
Fake
single
breakout.
bounce.
Mm-hmm.
You
That's
understand
crazy.
it's just noise against the tide. That steadiness of mind is what separates the trader who compounds wealth from the trader who churns himself into ruin. Have you ever noticed how the market tests your patience more than your intellect? It moves just enough to shake out the weak, to tempt the greedy, to frighten the timid. But if you are anchored by a clear trend, you aren't so easily shaken. You hold your ground because you aren't relying on guesses, you're relying on the visible path of least resistance. And isn't that what trading should be? Not a constant gamble, not a nervous roll of dice, but a deliberate alignment with the obvious. When you next look at a chart, don't ask yourself what you want it to do. Don't ask what your broker thinks it will do. Ask what is it actually doing. That is the only question that matters. If the answer isn't clear, then the market hasn't yet invited you in, and you must learn the discipline to wait for that invitation. Because in this game, impatience is the tax, that the market collects from those who cannot wait for clarity. When I think about trading, the one truth that rises above all others is this: every trade carries the possibility of loss. It's not a maybe, it's a certainty and probability. You cannot escape it, and that's why the second golden question is so vital: am I ready to lose? It sounds negative at first, doesn't it? Most people want to talk only about winning, about profit, about gains. But the wise trader knows that profits take care of themselves when the risk is handled.
Sometimes, you know, you could have done.
Loss is the only thing you must prepare for. And I'll
Look
ask
at
you
it,
right
keep
now,
going
before
higher.
you enter a trade, do you honestly decide what you're willing to lose? Or do you simply focus on what you hope to make? The problem with most traders is they treat losses like accidents, as though they are something that shouldn't happen if only they are right. But the market is not a machine that rewards being right in theory. The market is a battlefield where even the best setups can fail. A sudden piece of news, a shift in sentiment, a wave of selling from some big operator, it can turn your perfect plan into a losing trade in minutes. If you don't accept this in advance, if you don't prepare yourself mentally and financially for that outcome, you will panic when it happens. And panic is the destroyer of trading accounts. I've seen men make small fortunes and then watch them vanish, not because their ideas were wrong, but because they refused to admit when they were wrong. They stayed in too long, holding and hoping, saying to themselves, it'll come back. Have you ever said those words? It'll come back. They are poison in trading. A stock doesn't know you own it. A commodity doesn't care that you paid more for it yesterday. The market will not return to your entry price out of kindness. If it moves against you and the reason for your trade is invalid, you must accept the loss. That is discipline. Being ready to lose doesn't mean being careless. It means being deliberate. You size your position so that if the trade goes wrong, the loss is an amount you can accept without damaging your capital or your spirit. Because let me tell you,
Look,
if
keep
losses
going higher.
wound more than your account, they wound your confidence. And a trader without confidence is already defeated. That's why the question must be asked before entry. If you can't stand the loss, if it's too heavy for your comfort, then the trade is too big. Walk away or reduce the size. Many beginners imagine trading is about finding a magic formula that guarantees profits. They are wrong. Trading is about learning how to control losses so they never grow beyond your reach. The profits come as a byproduct of surviving long enough to catch the right trends. I've said before, and I'll say it again, you can be wrong half the time and still make money if your losses are small and your winners are allowed to run. But you cannot survive if even one or two losses wipe out weeks or months of work. Let me ask you, how many times have you built up a nice gain only to give it all back in one reckless position? It's not the winning that destroys traders, it's the losing without limits. Every man has a point where his emotions break. For one man, it may be $100. For another, 10,000. It doesn't matter the number. What matters is that if you cross the threshold, your judgment is clouded. You stop trading with clarity and start trading with fear or stubbornness. You hold on, you average down, you do all the things you swore you would never do, and the market punishes you for it. That's why preparation is everything. Before you enter a trade, you decide in cold blood where you will get out if you are wrong. You don't decide in the heat of the moment when your pulse is racing and the tape is moving against you. You decide before, when your head is clear, and then, when the price reaches the point, you act without hesitation. That is what being ready to lose really means. It means you accept the possibility as part of the business, and you plan for it with precision. Think of it this way. A merchant who sells goods knows that not every item on his shelves will sell for a profit. Some will be sold at a discount, some may spoil, some may never move. He doesn't cry about it. He prices them, he accepts the losses as part of the trade, and he focuses on his profitable stock. Trading is no different. Some trades will spoil, some will fail. Your job is to keep those failures small enough that they don't ruin the business. But let's talk about the mindset for a moment. because it isn't just about setting stops or sizing positions. It's about truly embracing the fact that losses are part of the game. Too many traders take a loss as a personal insult, as proof they are foolish. But a loss is simply tuition. It's the fee you pay to stay in the game. When I was young, I treated every losing trade as a wound to my pride. I would fight the market, double down, swear I would prove myself right. But the market doesn't care about my pride, and it certainly doesn't care about yours. Pride is expensive, humility is cheap. Which would you rather pay for? Are you willing to accept being wrong gracefully? That's the real test. Because every trader is wrong, even the best. The difference between the ones who last and the ones who vanish is that the lasting trader takes his medicine early, while the vanishing trader clings to hope. Hope has no place in trading, only facts do. And the fact is, the tape says you're wrong. Better to cut and preserve your strength for the next opportunity than to bleed out holding a bad position. This readiness to lose also frees you. When you know your risk, when you've already accepted it in advance, you trade without fear. You can sit calmly, watch the tape, and let the trade work. Because you know the worst case scenario and you've already agreed to it. Isn't that a better way to operate than to sit there, heart pounding, not knowing how much you could lose? The market is stressful enough without you adding uncertainty on top. The men who ignore this golden question always end the same way. They might ride a streak of good fortune for a while, thinking they outwitted the game. But sooner or later, a loss comes that they aren't ready for. And because they never planned for it, it breaks them. A single trade can destroy years of effort if you refuse to accept its risk in advance. And isn't that tragic, to build for so long, and then lose it all in one careless gamble? I ask you again, before your next trade, will you be ready to lose? Will you mark the line in advance where you admit you are wrong? Or will you keep believing that every trade must be a winner? Because the market doesn't care about your belief. It only respects discipline. And discipline begins with acknowledging loss as part of the business. When I talk about aligning a trade with your capital, I'm speaking of a principle that has ruined more men than bad ideas ever did. A wrong idea can sting, but an oversized trade can cripple. I've watched brilliant traders, men who read the tape as clean as a book, destroy themselves not because they lacked skill, but because they forgot their capital's limits. The third golden question, does this trade fit the size of my account, is one most traders skip, and they skip it at their peril. Let me ask you directly, do you size every trade according to your stake? Or do you sometimes stop because you feel extra sure? There's a great temptation when you see a perfect setup. The chart looks strong, the trend is clean, everything lines up, and you feel the certainty in your bones.
Crazy, keep going up, guys.
Put more on it.
$50 right now.
Go big. After all, why not? If you're right, the reward will be that much greater, and for a while, maybe it works. You catch the move, you make a killing, you feel brilliant. But sooner or later, the tape turns against you. And if you've oversized your trade, one bad move can undo weeks or months of careful building. Isn't it true you've had those trades where you thought you were being bold, only to realize later you were being reckless? The market doesn't reward recklessness. It punishes it relentlessly. I've seen men with a 10,000 accounts take a 50,000 positions on margin, smiling because they caught a rally and boasting of how fast their equity grew. And then one day, a sudden reversal wiped them out completely. Not only did they lose their account, they owed more. That is the danger of ignoring the fit between your trade and your capital. The leverage looks like a gift on the way up, but it's a curse on the way down. A trader must treat his capital like a soldier treats his ammunition. Every bullet.
Crazy guy. Crazy, crazy, crazy. Where does that come from? Where the mouth?
Your survival. When I learned this lesson, it was not from books or lectures. It was from losing big when I bet too heavily. I remember thinking, this trade can't miss. The thought alone should have been the warning, because the moment you believe a trade cannot miss is the moment you've stopped respecting risk. The tape has a way of humbling that kind of arrogance. I was forced to sell, not because the idea was bad, but because I had bet too much and could no longer afford
$51,
to
guy. 51.
Have you ever been thrown out of a trade too soon, simply because you couldn't stomach the size? That isn't the market's fault, it's your sizing. When your trade is
51.
scaled properly, you can sit still. You can let the market do its work. But when your trade is too heavy, every tick feels like a knife. You panic at small movements, you sell too soon, or you hold on too long trying to justify the risk you took. In both cases, the oversized position clouds your judgment. Instead of following the tape, you are following your emotions. And in trading, emotions are the most expensive advisor you can have. This is why the third golden question matters. Because it forces you to think about proportion. The best traders don't bet their whole roll on a single play. They scale according to their account. 1%, 2%, maybe 3% if most of their capital risked on a single trade. That way, no matter how wrong they are, they live to try again. They understand that the game is not about one trade, it's about thousands of trades over years. That's how fortunes are built, brick by brick, not in one bold gamble, but in steady accumulation. Think about this: if you keep your risk per trade small, you give yourself breathing room. You can lose 10 times in a row and still have capital to continue. But if you risk half your account on one trade, you only need to be wrong once to end the game. Isn't survival the first goal of trading? If you cannot survive, you cannot prosper. Aligning your trade with your capital is the way you ensure survival. There's another side to this question that most don't consider. When your position size is correct, you are not tempted to meddle with it constantly.
The thing we hear over and over again is, why do I need a deodorant for private parts? I can just take a shower. So we put Mando to the test and compared it to a shower alone. This is the odor score, 0 to 10. 0 being no odor at all, and 10 being the worst odor that you can possibly be on a human body. All participants in this study started at 0 out of 10. The first group of people were the people that didn't apply Mando at all. By hour 12, they were actually somewhere up in the 6 to 5. If you do not apply a deodorant to your private parts and you just rely on a shower to keep the odor free, you're going to be at 5 or 6 after 12 hours.
For the beginner who first gazes upon the vast and intimidating landscape of the stock market, the feeling is one of profound confusion. He is confronted with 1,000 different stocks, 100 conflicting theories, and a constant deafening roar of news, tips, and opinions. Where does one even begin? How can a novice hope to navigate this treacherous terrain without being swiftly and mercilessly consumed? The answer, according to the master speculator Jesse Livermore, is not to attempt to master the entire market at once, but to adopt a single, sound, and proven strategy, a foundational plan designed to align the trader with the market's most powerful and forgiving force, the great primary bull market. This is that plan. It is a simple, sequential, and logical 5-step guide, a distillation of Livermore's own hard-won wisdom, specifically tailored for the speculator who is just beginning his journey. This is not a get-rich-quick scheme, for he knew such things were a myth. It is a get-smart-and-survive plan, a methodology for building capital and confidence by operating only when the great probabilities are overwhelmingly in your favor. To follow this plan is to abandon the reckless, impulsive habits of the amateur and to take the first critical steps onto the path of the professional. He understood that the great tragedy of the novice is that he tries to do too much, too soon. He attempts to trade every fluctuation, to have an opinion on every stock, to be a bear one day and a bull the next. He is a man fighting a multi-front war with no training and no strategy. The result is inevitable defeat. This 5-step plan is the antidote. It is a framework for radical simplification. Of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. The plan begins not with the stock, but with the condition. Step 1, confirm the bull market. This is the first and most important commandment for any beginner. The novice speculator has no business attempting to sell short or to trade in a choppy, sideways market. These are the games of seasoned, experienced professionals. The beginner's only game, the only arena where the odds are tilted significantly in his favor, is the long side of a great confirmed primary bull market. If this condition is not present, the plan does not begin. The first step, and often the most profitable, is to do nothing at all. What is a bull market? It is not a matter of opinion or of reading bullish headlines in the newspaper. The line of least resistance is unmistakably upward. It is a time when the general list of stocks is making a series of higher highs and higher lows. It is a time when the leading industry groups are emerging with force, their component stocks pushing into new high ground with ease and conviction. It is a time when the market readily absorbs profit-taking and treats bearish news with contempt. The beginner's first task is to learn to recognize this condition, to become a student of the market's overall character. He must learn to distinguish the powerful, sustained advance of a primary trend from the deceptive, short-lived rally of a bear market. He must have the supreme patience to sit in cash, to wait for weeks or even months if necessary until this great favorable tide is undeniably rolling in. Trade without this tide at your back is to row a small boat against a hurricane. With the great primary trend confirmed, the checklist moves to the next critical step of filtration. Step 2. Identify and follow the leaders. Even in the strongest bull market, not all stocks are created equal. The great upward force of the trend is never distributed evenly. It is always...
Mà cái thằng TNFL mới livestream nè, nó break 6 đồng y chang. I do livestream exactly, man. Okay, TNFA, crazy. Oh man, look at that guy. Ta đoán trước y chang. Ghê hả? Ta đang livestream này, coi được chưa? Đang làm việc hả? You treat thằng nào test đi rồi mình check lại, mình bỏ lên online. I tell you why. Jesse, tao để lên livestream, tao nói cái tối mày học quá. Mê cái thằng TNFA quá đã luôn. Look at them right there, big breakout, crazy guy. Everything can happen.
Looks too high to the amateur, so he understands that a new high is a sign of power, not of risk. Now, Livermore was a master at observing that a bull market was in force, that certain stocks were acting as leaders. But why does this happen? What are the unseen forces?
Look, you guys see that right here? pull back.
For that, we turn to one of his
Huh?
contemporaries,
When they pull back, let it pull back, okay?
the art of speculation, but who
Right here.
science, Richard Wyckoff.
Crazy guy.
While Livermore was the supreme speculator, acting on the tapes immediately.
Right here. See, wait and see.
Supreme analyst.
You can wait and see right here, waiting, right here. Pull back the line. It says they'll be in ball plus. Look at break again. You jump in, the volume pick up again. Same thing. Classic guy. You sell right here, you sell right here. Look at the fake breakout right there. The short George start there. Short George you start here. Short here. And then this one hold right here. At power lunch.
The link is in the description
If
below.
power lunch, if this one break, it can go higher. That's it.
He must walk
Crazy guy. Fake breakout.
groups that are the first to make
Let's see bear flats again.
He must
Let's see another ball flats.
advancing on a surge of volume, a sign of broad and aggressive buying. He must observe which stocks are the most resilient during the market.
Crazy guy.
Giving up the least ground and being the first to rebound with vigor. He must, in short, learn to distinguish the generals from the common soldiers. The story of Chester Motors is the ultimate cautionary tale. While the entire automobile group was soaring in a great bull market, Chester stubbornly refused to advance. The public, seeing it as cheap, began to buy. Livermore, reading the tape, saw its weakness as a definitive sign of disguised inside selling. He sold the stock short and profited handsomely when its internal problems were finally revealed to all. He had obeyed the second great step of the plan. He had shunned the latter. By completing these first two steps, the beginner has dramatically and profoundly tilted the odds in his favor. He has ensured that he is trading only in the most favorable of all market conditions, and that he is focusing his capital only on the highest probability, most powerful of all stocks. He has eliminated the two greatest sources of amateur failure, fighting the primary trend and betting on weak, underperforming stocks. He has now completed the strategic portion of his campaign. He is now ready to move to the tactical execution, the final three steps that govern the trade itself. Having completed the first two strategic steps of the plan, the beginner now stands in a position of immense analytical advantage. He has confirmed that the great primary tide of the market is at its back, and he has identified the single strongest ship, the leading stock on which to make his voyage. He has already eliminated the two greatest sources of amateur.
Look at break right there, guys. See.
But a brilliant analysis and a powerful vessel are worthless without a skilled captain at the helm. The final three steps
Nice, huh?
are the tactical commands of that captain, the mechanical rules of execution that transform a sound idea into a safe and profitable trade. This brings us to the
TNFA. Crazy.
the element that separates all professional operations from amateur guesswork. Step 3. Time the entry.
That's called short squeeze right there, guys. Short squeeze.
A beginner, having found his leading stock, is now consumed by an anxious desire to get aboard. He is terrified of missing the move. This impatience is a fatal flaw. Jesse Livermore knew that the right stock bought at the wrong time is always a losing trade. To enter a stock while it is still consolidating or in the midst of a reaction is to risk having...
All right, my friend, he tested to me called FTEL.
The professional
Okay.
shapes. He does
Look at
not
here,
guess.
guy.
He
Crazy.
waits. He waits for the market's own unequivocal signal that the period of
FTEL.
preparation is over and the real sustained advance
Pump and
is
dump.
about to begin. This
Right here, you need to get out right here.
is a decisive breach of a pivotal point. For
Pump.
the beginner, the simplest
That
and
break?
most powerful
No volume?
point to watch for is the stock
They have no volume. Why buying?
period of consolidation or
Okay.
eventual healthy
These have no volume. Don't touch
This
it.
is not just a price.
You FOMO, that's all.
Power. It is the market.
I saw DJ
All the latent selling pressure has been absorbed.
DBGI.
Least resistance is now clearly and decisively up.
Be same thing. No volume, guy.
Supreme
Pump,
patience to wait
dump.
at this moment.
You have to wait.
He must walk
You have to
his
be
chosen
patient.
route.
When you pump, you got FOMO.
Nothing.
You FOMO right
He
there.
must fight the internal nagging.
They have no volume too. No volume, no trade,
His
guy.
discipline in this waiting period is the
No volume, no trade.
potential as a speculator.
FLD, Ross, he buy this yesterday.
Becomes active until it makes a new high.
This one okay,
Know that market-wise you have
but
been
there's still no volume.
with the pivotal point finally reached and the signal given.
Still no volume.
Checklist immediately moves
Yesterday it's from $5 to 10 right there. Look at it.
Step 4.
Rossi make money
Start
from
small
here.
and define your risk.
$7 right there. Right now today pump backside.
Beginner's survival.
This is a backside. Don't
The
touch
amateur,
it.
in his excitement, is tempted to go all in, to commit his entire intended line at
This
this
one start to move right here. This one
This is a catastrophic.
right there. Okay. Okay. This one move right now. Break $3. Okay. The palm no volume. No volume. No trade guy.
The beginner's
Look at this one.
should always be
Look at
small,
this guy. Look at this.
a fraction of his total intended position. Perhaps
I like you on this one. Look at us. Crazy, huh?
this is
Show you guys. Look at that.
it is a test.
Watch the video again. Beginning, I said this one, you sell right here and you buy back. Okay? You buy back right here. This is a good wait and see right here, guys. Wait and see setup.
It is a cautious, professional way to enter a new and uncertain venture. Before this probe is even sent out, the risk
When the stock go up, okay? You wait and see again.
The beginner must determine his point of surrender, his stop loss, the price at which the trade is proven to be a mistake.
Right here,
This is not
guys.
a mental stop, but a hard, unchangeable.
This is a good lesson right here. Wait and see.
Single act transforms the trade from a wild gamble.
Look at that. Keep go higher. This one, I jump right here. I sell right here. Pull back.
Application of
Jump.
rigorous
You need to jump back here. You sell right here. You jump back right here. Okay?
Now in the market, the checklist.
Right here, guys. Look at here.
Step.
Oh, here. See right here?
This
This is an A plus setup.
the small winners from the
This is an A plus setup.
It
You
is
jump, you sell here.
difficult of all.
Ball plus.
Having success-
Break ball plus. You jump back in right here.
The beginner will now have a small.
This is an A plus setup right here. Wrong, you get out right here. Let it go. Let it run. And then you sell 7, sell half. Let's see what's going on right there.
This Livermore knew was
Look at that guy.
of the trading public. He stated it with the conviction of a man who had seen it 1,000 times.
This is a good setup right here, guys. Very good.
Right. Do not be in a hurry to take a profit. The beginner must understand that the goal of this entire 5-step plan is not to scout a few points. It is to capture a significant portion of a major bull market move.
Good setup, guy. Good setup.
The first sign of a profit is to abort the mission just as it is.
TN.
The beginner must now summon
Yep,
a new and unfamiliar quality, the courage to sit tight. He must have the fortitude to hold his winning position through the minor, nerve-wracking but perfectly normal reaction.
Look at it holding right now.
Of every great advance. His confidence should not be in his own courage, but in the soundness of the process that has brought him to this point. He is in the right market, in the right stock at the right time. The profit on his account is the market's own validation of his judgment. His job now is not to trade, but to manage, to have the intelligent patience to let his correct decision blossom into a truly substantial gain. If the trade continues to act right, this is the time to practice the professional art of pyramiding.
That's a nice squeeze, guy.
Position on a rise.
That's called short squeeze right there.
In step 4 of the previous block. The initial probe has now become the foundation for a larger campaign. A campaign financed not by hope, but by the market's own proven success. This 5-step plan, then, is a complete and holistic strategy. It is a safe and logical path for the beginner to follow. It forces him to be patient. It forces him to align himself with the market's most powerful forces. It forces him to focus only on the highest quality opportunities. It forces him to manage his risk with professional discipline. And it teaches him the most difficult and most profitable skill of all, the courage to let a winner run. To adopt this plan is to take the first great step away from the chaotic, emotional world of the amateur gambler and toward the calm, disciplined, and business-like world of the professional speculator. There is no easier or safer way to begin the long and difficult journey to market mastery. It is a plan proven not by abstract theory, but by the timeless wisdom and the hard-won $1 million experience.
Hold it right there, guy. Hold it.
To truly understand the mind of the man who forged these principles, to witness the epic market battles where this very plan was put to the ultimate test, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological...
No volume, no trade, guy.
A narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate the century-old wisdom for the modern reader, is provided in the description below. There is perhaps nothing more dangerous in the world of speculation than a brilliant idea. It arrives in a flash of insight, elegant in its logic and seductive in its promises. It feels like a secret key, a map to a hidden treasure that you alone have discovered. And acting upon this raw, untested idea is the single greatest and most consistently fatal error a speculator can make. The markets are a graveyard for brilliant but unverified ideas. The novice trader enters this arena armed with them, collected from forums, whispered by so-called experts, or born from a gut feeling after watching the chart for a few hours. They see a pattern, they form a theory, and they mistake this creative act for sound analysis. They are convinced they are right, and the market owes them a profit for their cleverness. This is the foundation of ruin. Jesse Livermore learned this lesson not through quiet contemplation, but through the painful, repeated process of losing his entire stake. He learned that the market has no obligation to reward your intelligence. It does not care about your beautifully constructed theory. It is a force of nature, and it respects only one thing, evidence. An untested trading idea is pure opinion. It is a hypothesis with no data. To risk hard-earned capital on an opinion is not speculation. It is the most reckless form of gambling. You are betting that your singular view of the world is correct, without ever consulting the one source that holds the answer, the historical record of the market itself. This journey from opinion to evidence is the defining struggle of any serious...
Right here.
To understand the
I live streamed this morning. I said, I jump in here, I sell right here, pull back, and they say sell right here. I draw the line right here, exactly, wait and see, and curve back up right there. Easy, guys.
Livermore's trials and triumphs, chapter by chapter, is an invaluable guide to these lessons, and a link to it is in the description below. The hidden risk of an untested idea is that it is by definition a complete unknown. You are stepping onto a battlefield with no knowledge of your weapon's accuracy or your armor's strength. You have no idea of the probabilities. What are the chances of this setup succeeding? When it fails, how much does it typically lose? How many times in a row can it fail? Without answers to these questions, you are trading blind. Consider a simple idea. Buying a stock when its 50-day moving average crosses above its 200-day moving average. The golden cross. It sounds logical. It implies a shift from a long-term downtrend to an uptrend. Many traders have taken this idea and run with it, risking their capital on its apparent soundness. But what does this
Look at it open. 880, guys. Look at 880.
Does it work in all market conditions or only in bull markets? What is its statistical win rate?
All right, it happened every day. Watch my live stream, guy. Right here. Resistance 620. I jump in here, I sell here, pull back. You have to wait and see. No short, no squeeze. And look at that. Right now, open $8.
The speculator is filled with a sense of genius. Their ego is inflated. I knew it, they think. My idea is the one. This single random success gives them the confidence to bet even bigger the next time, reinforcing a potentially flawed process. When the trade fails, they chalk it up to bad luck, a fluke, or market manipulation. When a series of them fail, they are thrown into a state of utter confusion and despair. They have no framework for understanding what is happening. Their system has betrayed them, but the truth is they never had a system at all. They only had a guess. Livermore, in his mature phase, was the opposite of this. He was a scientist of market action. He kept meticulous records not just of his trades, but of the behavior of stocks under specific conditions. He was manually backtesting, studying the past to understand the probabilities of the future. He was replacing opinion with statistics. This is what testing provides. It strips an idea down to its statistical soul. The first thing a rigorous backtest reveals is the simple win rate. How often over the last decade and across hundreds of instruments did this idea produce a winning trade? The answer is often humbling and immediately exposes the weakness of many cherished theories. But the win rate is only the beginning. Far more important is the relationship between the average win and the average loss. An idea that wins 60% of the time can still be a catastrophic loser if the average loss is 3 times larger than the average gain. Conversely, a system that wins only 40% of the time can be a fortune builder if the wins are multiples of the losses. This calculation produces the ultimate method, expectancy. Expectancy tells you over a large sample of trades what you can expect to make or lose for every dollar you risk. A positive expectancy is a statistical edge. It is the faint, almost imperceptible tailwind that, over time, will carry you to success. A negative expectancy is a headwind that will inevitably drive you into the rocks, no matter how hard you try to sail against it. Trading with an untested idea is trading with an unknown expectancy. You are, in all likelihood, trading with a negative expectancy. You are paying the market for the lesson that your idea is flawed. The professional speculator does the opposite. They let historical data pay for their education and only risk real capital on ideas that have been proven to have a positive expectancy. But this raises the critical question: how does a modern trader who isn't a programmer actually perform this rigorous testing? This is the exact problem that a tool like Agentia was built to solve. It's a no-code strategy builder that allows you to take your unique trading ideas and translate them into a testable system using plain English and a drag-and-drop interface. You don't write code, you assemble your logic. Agentia then generates the professional
150% in 5 minutes, guys.
Ninja Trader or TradeStation, allowing you to run deep historical backtests. It's the bridge for the creative thinker, turning your brilliant idea from a dangerous guess into a statistically analyzed hypothesis, ready for the judgment of historical data. For anyone who has ever thought, I have a great idea but I can't code, there's a link to explore this path in the description. The process of testing is a great filter. It allows a speculator to take 100 different ideas and with cold, unemotional rigor, discard the 95 that are worthless junk. This is not a failure. It is a monumental success. You have saved yourself from the certain financial debt that would have come from trading those flawed ideas. You have preserved your capital, your most precious asset. But this path of the system builder requires immense time and effort. This leads to an alternative, equally valid path for the evidence-based trader. This is the path of leveraging pre-vetted research, which is where a service like Stock Market Guides comes in. Their team has already done the brutal work of filtering. They've back-tested millions of combinations of stocks and patterns to find a small percentage that have a persistent statistical edge. Instead of building from scratch, you get access to their scanner and alerts, which deliver only the trade ideas that have already survived the testing process. It's for the trader who understands the value of a proven edge but prefers to focus their energy on analysis and execution rather than on invention. If your goal is to trade proven setups without the years of development work, the link to this done-for-you research is also in the description. Whichever path you choose, building your own system or using pre-vetted research, requires a level of intellectual honesty that most people lack. It requires you to be more committed to the truth than to being right. For those who have been burned by a can't-miss idea, for those who have felt the sting of a blown-up account, this channel is a place to rebuild. The psychological aspect of this is profound. Trading an untested idea creates a powerful illusion of control. The trader believes they are a master strategist, outthinking the market. They feel they have discovered a secret, a holy grail that no one else sees. This is the siren song of the ego, and it leads directly to ruin. The reality is that this trader has zero control. They are a leaf in the wind, completely at the mercy of random outcomes. They are a gambler at a casino, mistaking a lucky streak for a repeatable skill. The market, like the casino, holds the ultimate statistical edge against all who play without one of their own. Livermore's most devastating failures came when he abandoned his evidence-based rules and acted on an untested idea, often one given to him by someone else. His catastrophic loss in confidence was a direct result of trusting the brilliant idea of an expert, Percy Thomas, over the clear, contrary evidence of the ticker tape. His ego allowed him to believe in a story, and he paid for it dearly. The process of testing an idea destroys this illusion of control, and it is a painful process for the ego. But it replaces that fragile illusion with something far more powerful: genuine, resilient confidence. The confidence of a professional speculator does not come from the outcome of the next trade. It comes from the statistical certainty of their proven edge over the next 1,000 trades. A trader with a tested system can endure a string of 5, 6, or even 10 losing trades without losing their nerve. Why? Because their backtesting has shown them that such a losing streak, while unpleasant, is a normal and expected part of their system's performance. They know it is just statistical noise within a profitable long-term framework. The trader with the untested idea, however, is destroyed by 3 consecutive losses. They have no historical context. They panic. They abandon their idea and jump to the next one, repeating the cycle of hope and despair, forever searching for a magical formula that does not exist. Discipline is impossible without a tested set of rules. How can you be disciplined in following a plan when you have no statistical reason to believe that the plan works in the first place? You cannot. You will inevitably override it at the first sign of trouble because your belief in it is built on sanity. The greatest risk a speculator faces is not a market crash. It is not a black swan event. It is not a volatile stock. The greatest risk lies between their own ears. It is the unexamined, unchallenged, and deeply held belief in their own untested ideas. It is the arrogance of assuming you are right without demanding proof. Livermore's entire career was a journey away from this arrogance. He started as a boy wonder who could guess the market's next move. He ended as a master who knew that guessing was a fool's game. He learned to subordinate his own brilliant ideas to the humble, tedious work of observation, recording, and confirming. He learned that you do not invent systems, you discover them. The patterns, the tendencies, the behaviors that produce a statistical edge are already there, embedded in the historical data of the market. The speculator's job is not to create, but to listen, to test, and to identify these faint signals in the overwhelming noise. A trading idea begins as a hypothesis. I believe that when X and Y occur, Z is more likely to happen. The amateur takes this hypothesis and bets the farm on it. The professional takes this hypothesis and says, "Show me." They go to the data. They ask the market's history. Is this true? How true is it? And under what conditions is it true? Only if history answers in the affirmative do they proceed to the next step, risking a small amount of test capital to see if the edge persists in live market conditions. The process is slow, methodical, and scientific. It strips all the romance and excitement out of trading and turns it into a business. This is why so few succeed. They come to the market seeking excitement, action, and the thrill of being right. The professional is there for one reason only: to execute a tested edge with relentless consistency. Their work is often boring. Their discipline is absolute. Their success is a byproduct of this process. not a goal in itself. So before you risk another dollar on the next brilliant idea stock, ask yourself the hard questions. What is the historical evidence for this idea? What is its win rate? What is its expectancy? What is its maximum historical drawback? If you do not have precise statistical answers to these questions, you do not have a trading system. You have a guess. The market is an expensive place to find out that your guess is wrong. The intelligent speculator uses the cheap data of the past to filter their ideas, rather than the expensive data of their own trading account. The final lesson is this. The market does not pay you for having ideas. There is no reward for creativity or cleverness. The market pays for one thing and one thing only. The disciplined execution of a statistically validated error.
Hey traders, awesome to see you all here. Again, thanks for joining. Just an important announcement, this stream here is delayed. If you want to get access to the live features, so the live time, the live commentary, access to our private Discord group chat, then use the link that we have in the description just under this video, guys, and also the link to gas bill. Kindly to hit the like button, subscribe to the channel if you haven't done that already, and again, I'll see you guys out there. Thank you all.
It is a deep psychological portrait of a master at work, a chronicle of the very experiences that forged this powerful framework. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. The entire process begins not with a stock, not with a chart, but with a broad, sweeping assessment of the entire market. The first and most important step on the checklist is this. Step 1. Assess the general market trend. Before he ever considered buying or selling a single share of any company, Livermore had to have a clear, unwavering conviction about the direction of the primary market current. Was he in a great bull market or a great bear market? This was the foundational question upon which all subsequent decisions would rest. He knew with the certainty of a man who had been bankrupted by ignoring this very rule that the big money must necessarily be in the big swing. He was not interested in playing for small, nervous reactions against the primary trend.
All right, get down, get up, get down.
A certain way.
Let's see what going on, guy.
Commissions and whipsaws. His goal was to identify the great underlying tide, the line of least resistance, and to set his sails in perfect harmony with its powerful, irresistible flow. To fight this trend, he believed, was a form of insanity. He stated it as a simple, almost childishly obvious truth. The thing to do was to be bullish in a bull market and bearish in a bear market. Yet, he saw traders violate this principle every single day. They would try to short stocks in a roaring bull market simply because the prices seemed too high. Or they would try to buy bargains in the midst of
Crazy guy.
hoping to catch the bottom. These were not acts of courage. They were acts of ego, of a man pitting his own small opinion against the market's gigantic impersonal force. This first step required patience and study. It was not a guess, but a diagnosis based on a careful analysis of general conditions. He would study the money supply, the state of credit, and the health of the nation's key industries. He would observe the market's own behavior, its reaction to news, its ability to absorb selling, or its failure to sustain rallies. He would wait, sometimes for months, until the character of the market was unmistakably clear to him. Only then, with a firm conviction about the primary trend, would he proceed to the next step. With the great strategic direction established, the checklist moves to the next level of filtration. Step 2. Identify the leading industry group. Livermore knew that even in the strongest bull market, not all stocks advance equally. The great power of the primary trend is always concentrated in a few select industry groups. In his day, it was the railroad, then the steels, then the motors. These were the generals, the vanguard that led the entire market army. As they go, he said, so goes the whole market. His rule was to confine his studies and his capital to these prominent leading groups. To spread oneself thin across the entire list, to have an interest in a dozen different sectors, was to invite confusion and mediocrity. It is much easier to watch a few than many, he insisted. By focusing his analytical firepower on the handful of groups that were demonstrating the most profound strength, he dramatically increased his odds of success. He was not looking for a needle in a haystack. He was looking for the most powerful locomotive at the head of the fastest train. The leading group was not a matter of personal preference or fundamental analysis alone. It was a fact, proven by the action of the ticker tape. The leading group was the one that rallied first and strongest after a market correction. It was the one that made new highs with the greatest ease. It was the one that showed the most resilience to sudden pressure. Its leadership was a visible, tangible thing to the trained observer. This second step, then, acts as a powerful filter, narrowing the speculator's focus from the entire market down to the single sector where the greatest opportunities reside. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need
Whoa, all the way down, guys.
Having identified the market's strongest battalion, the checklist...
Get up, get down, you take profit, that's all.
Step 3.
Always take profit.
Select the leader within the group. This is the final and most critical
When the
aspect.
break $9 go higher. How high can this one go? Let's see. How high can it go? Or how low can it go? Look at it. Almost $10, guys. Look right here.
While their peers follow in their wake. The amateur, in his quest for a
Right there.
will almost always be tempted to buy the laggard, the stock that has not yet moved, believing it is due to catch up. Livermore knew this to be a fatal and fundamental error. A laggard, he understood, is not a bargain. It is a weakling. Its failure to advance...
You go up right now. Let me hit the bell. That means relax. You go up.
There is always a reason.
$8 resistance.
A reason that is often invisible to the public until it is too late. The professional does not buy weakness, hoping it will turn to strength. He buys proven, demonstrated strength, and he buys more of it to become stronger. His rule was absolute. Concentrate your fire on the leader of the leaders. The leader is identified by its behavior on the tape. It is the stock that moves first.
8,
It is the one that makes the largest
8,
percentage
9,
gain
10.
and the highest volume. It is the one that acts right. It absorbs profit-taking with an ease that is almost contemptuous. It feels
A lot of pressure at 8.
powerful and alive. It is the stock that everyone is watching, the one that is making the headlines. To buy this stock, even at what seems like a high price, is not an act of chasing. It is an act of aligning oneself with the market's most powerful, concentrated force. His famous campaign in the steel stocks was a perfect illustration of this principle. He was bullish on the entire group, but he did not buy all the steel stocks equally. He began by testing both U.S. Steel and Utah Copper. From the very first day, U.S. Steel acted like a true leader, moving with power and purpose. Utah Copper, in contrast, was sluggish and unresponsive. Heeding the tape's clear verdict, he concentrated his full financial firepower on the proven leader, U.S. Steel, while leaving the laggard
It's
alone.
called wait and see,
This
guys.
single
Wait and see.
disciplined decision was the key to one of his most
Always take profit right there.
This third step completes the strategic selection process. The speculator has now moved from a broad assessment of the entire market down to a single high probability candidate. He has identified the strongest stock and the strongest group in a market.
Wait and see working, guys. Wait and see working.
The odds are now overwhelmingly in his favor, but the checklist is not yet complete. The final tactical steps of timing, risk, and confirmation still lie ahead, the crucial bridge between a brilliant analysis and a profitable trade. Having completed the first 3 strategic steps of the checklist, the speculator has achieved what few amateurs ever do. He has identified the single most promising candidate for a major move in the entire market. He has filtered the universe of stocks down to the leading stock in the leading group, in a market whose primary trend is aligned with his intended trade. The great probabilities are now on his side, but a brilliant analysis is worthless if it is not matched by a flawless tactical execution.
Check our QURE.
To govern this critical phase, to bridge
QURE break one more time. It break couple
and a profitable
last year, I
This
think.
brings us to the fourth and perhaps most difficult step of the entire process. A step that tests a man's discipline to its absolute limit. Step 4. Wait for the pivotal point. Jesse Livermore knew that the greatest and most costly mistake in speculation was not being wrong, but being wrong at the wrong time. To be correct in your analysis, but premature in your action, is to invite a slow and agonizing financial death. You are whipsawed by meaningless fluctuations. Your capital is eroded and your nerve is shattered long before the real profitable move ever begins. He learned this lesson not in theory, but in the brutal reality of his own account statements. He
$8.
the pain of experiencing his words. After forming a definite
This one can run.
respect to a certain stock, do not be too anxious to get into it. Wait and watch the action of that stock. He knew that a stock, even one destined for a great advance, must first complete its period of quiet, unseen accumulation. To enter during this phase is to have your capital lie dormant and unproductive, or worse, to be shaken out by the deliberate engineering.
All right, this one moving right now. Sheep right here, moving back right here. Right there, guys, moving right now. Let's see the volume.
This signal for Livermore.
This one can squeeze. Go all the way up. It break 750. You can go to $8.
Where the long period of preparation was over and the public marking up stage was about to begin.
Volume pick up.
At this precise juncture, and not a moment sooner, that he would consider committing his capital. The wait might be days or it might be weeks, but the discipline to wait was non-negotiable. With the market finally arriving at the predetermined pivotal point, the checklist moves to the fifth and critically important step.
Only right here.
Step 5.
750.
Define your risk. Before placing a single order, before a single dollar is put on the line, the professional speculator must answer the most important question of his business.
Need to break 750. Look, try right there, 740. Right there.
This is not a question to be answered in the heat of battle. It is a cold, calculated decision made in a moment of complete emotional detachment. Livermore treated his capital as a general treats his army's reserves, as a finite and precious resource to be guarded with the utmost seriousness. He wrote,
Look at $8, guys. Look at $8.
Broker, and the only way he can continue in business is to guard his capital account.
If you see 810, you see $9.
A line in the sand. It is the stop loss, the predetermined point of surrender where the trade is proven to be a mistake and the position must be closed without question or hesitation. To enter a trade without this clearly defined exit point is to engage in a form of financial madness. It is to sail into a hurricane without a rudder, to enter a battle without a plan for retreat. The amateur thinks only of the potential profit. The professional thinks first of the potential loss. By defining his risk beforehand, the speculator transforms a reckless gamble into a calculated business venture. He has controlled the one variable in
Right here, $8. Be careful.
that is completely within his power to control.
This one right here, curve.
Of his own loss.
Right here,
With the trend, the stock, the
$10.
and the risk all clearly defined, the checklist arrives at the moment of action. Step 6.
only when it break 8,
Execute the
810.
code. Even now, with every condition aligned in his favor, Livermore would not charge into the market with his full intended line. He was not a player in the reckless sense of the word. His first move was always a test, a small exploratory commitment. He would buy a fraction of his total intended position, perhaps 1/5 or 1/4. This was his final practical question to the market.
Allow volume but not
He
breakout.
had his analysis, he had waited for a signal, and now he was asking the tape with his own money, am I right? This method of starting small is a profound principle of risk management. It ensures that if, for some unforeseen reason, his judgment is immediately proven wrong, his loss is kept to an absolute minimum. It is a final cautious step into the water before committing to the full fund. The amateur in his greed does the opposite. He enters his full position at once, maximizing his risk at the moment of maximum uncertainty. The professional, in his prudence, enters a small position, minimizing his risk until the market has given its final unambiguous confirmation. This brings us to the seventh and final step of the checklist, the market's own answer to the speculator's probe. Step 7. Demand immediate
Right here,
confirmation.
ball plus.
This was, for Livermore, the ultimate and most powerful validation of his entire analytical process. A correctly timed trade, made in a true market leader at a genuine pivotal point, should not hesitate.
It should break right there. If not, if this one breaks down 7, the dump it all the way down to a rewrap.
Scalping game. It was a demand for
Rewrap right here is 630.
The market's immediate line of least resistance. He stated it as one of his most foundational beliefs. Experiences
Right here, 630, guy. Important right here, 630.
A stock or commodity showing
They have 3 line right here. Maybe chop right here, all over. Break here, go 9, all the way 10.
And that the path was clear for a sustained advance. It was the market.
Let the market tell you what to
the
do.
final signal of his campaign to proceed with confidence. If, however, the trade immediately showed a loss, it was a red light, an equally clear signal that his timing was flawed. The market was not ready. There was unseen resistance. To hold on to such a trade was to substitute hope for the clear, factual evidence of the tape. The checklist demanded one course of action: exit immediately. Honor the stop loss defined in step 5. Accept the small diagnostic loss and return to a position of cash, waiting for the next, more opportune moment. This 7-step checklist, then, is a complete holistic system for professional speculation. It is a journey that begins with a broad, strategic assessment of the entire market and ends with a specific, tactical, and confirmed trade. It is a process that forces the speculator to move from opinion to analysis, from analysis to a plan, and from a plan to a disciplined, unemotional execution. It leaves nothing to chance, nothing to hope, and nothing to fear. It is a framework that transforms the market from a casino into a business. Each step is a logical and necessary prerequisite to the one that follows. To skip a step, to act out of sequence, is to break the chain of logic and to reintroduce the element of a gamble. By adhering to this checklist, a speculator ensures that he is always trading with the great probabilities on his side, that his timing is precise, that his risk is controlled, and that his judgment is confirmed by the only authority that matters: the market itself. This was the source of Livermore's power. It was his roadmap to fortune. A guide that is as true and as essential today as it ever was. Failure is a clear and honest teacher. It arrives with the brutal and unambiguous verdict of the ticker tape, and it forces a man to confront his own ignorance, his own weakness, or his own lack of discipline. A great loss is a painful but powerful education in the realities of the market. A great success, however, is a subtle and charming poison. It is the most dangerous intoxicant on Wall Street. It whispers in a man's ear that he is a genius, that he has solved the puzzle, that the market is a simple instrument upon which he can play any tune he wishes. It is in the warm, triumphant glow of a great victory that a speculator's worst and most fatal mistakes are almost always born. This is the great recurring tragedy in the life of any speculator who achieves a monumental success. Jesse Livermore, perhaps more than any man in history, was a living testament to this grim cycle. His greatest and most catastrophic downfalls did not come when he was struggling, but when he was at the very pinnacle of his power, after his most legendary triumphs. His story is a profound and timeless cautionary tale about the seduction of success. It is a clinical analysis of the psychological traps that are sprung not by defeat, but by victory. It reveals how the very emotions that accompany a great win, the surge of confidence, the feeling of infallibility, the hunger for an even greater prize, are the ones that relax a man's discipline and push him toward the abyss of a new or even more devastating ruin. This entire philosophy, this deep understanding of the psychological pressures that a great success creates, is a central and recurring theme in the one indispensable text on the mind of a master speculator. The story of Livermore's triumphs and his subsequent self-inflicted defeats is chronicled with brilliant clarity by Edwin Lefebvre. A link to his essential work, Reminiscences of a Stock Operator, now with a unique, detailed, chapter-by-chapter analysis from Max Davidson, is left in the description below this video. This new analysis is specially designed to make the timeless wisdom of the book powerfully relevant for modern readers. To understand this phenomenon, one must first dissect the psychological state of the speculator in the immediate aftermath of a great and successful campaign. He has correctly anticipated a major market move. He has backed his judgment with his capital, and he has emerged with a fortune. He is, for that moment, a king. He has not merely been lucky. He has been right, in a way that has been publicly and financially validated. The world looks upon him as a genius and what is far more dangerous. He begins to look upon himself in the same way. He experiences a state of profound mental intoxication. The powerful and addictive emotions of triumph and validation flood his mind. He feels that he has not just analyzed and profited from the market. He feels that he has, in some fundamental way, conquered it. This feeling of infallibility is the first and most dangerous symptom of the disease of success. The man begins to believe that the laws of the market, the laws of risk and probability that govern all other men, no longer apply to him. He has ascended to a higher plane of understanding. The first casualty of this new state of mind is the speculator's most essential and protective quality, his humility. The true professional, even at the height of his powers, maintains a deep and abiding humility before the market. He knows that he is a student, and the market is his teacher. He knows that his success was a product not just of his own skill, but of being in harmony with the great, impersonal force of the prevailing trend. He is grateful for his success, but he does not take all the credit for it. The man who has been seduced by his own victory, however, loses this perspective. He begins to believe that the market's trend was not a force that he correctly diagnosed and followed, but a force that he, through his own genius, somehow commanded. The student begins to see himself as the master. This subtle but profound shift in mindset is the beginning of the end. For the moment a man stops listening to the market and begins to listen only to the sound of his own applause, is the moment his next great failure becomes a certainty. The second symptom that follows is the quiet and then blatant abandonment of his own time-tested rules. The entire science of speculation is built upon a foundation of rigid, inviolable rules of risk management. These rules are forged in the fire of losses, and they are designed to protect the speculator from his own human weakness. Rules for position sizing, for the cutting of losses, for the pyramiding of a position. These are the tools of a fallible man who respects the market's power to inflict ruin. But the speculator who now feels infallible begins to see these rules as a set of crutches that he no longer needs. They are for the amateurs, for the novices, for the man who used to be. He is a genius now, and a genius can trade on inspiration alone. He begins to take larger positions than his own scientific formula would dictate. He is no longer risking a small, calculated fraction of his capital. He is making massive bets, confident that his judgment cannot be wrong. He becomes lax with his stop losses. He holds on to a small loss, believing his genius will be vindicated and the trade will turn around. He begins to make exceptions to his own ironclad laws, telling himself that this time is different. He has forgotten the most crucial lesson of all, that on Wall Street, the moment a man believes that this time is different, he has already paid for the expensive lesson that will soon teach him that it's not. The third symptom of this disease of success is a change in a man's fundamental desire. The desire that drove his successful campaign was a definite and specific one, to profit from a single, well-analyzed market move. Now with a great fortune in his pocket, a new and more dangerous desire takes its place. It is the insatiable hunger for more. A great profit does not satisfy a man. It often only whets his appetite for an even greater one. The desire to make $1 million is instantly replaced by the desire to make 10 million. This new desire is not a calculated, strategic one. It is a raw, emotional, and greedy one. The speculator is no longer content to be a patient hunter, waiting for the next perfect opportunity to present itself. He now feels the need to force the action, to make something happen, to keep the game going at all costs. He begins to see potential trades where none exist. He mistakes the minor, meaningless fluctuations of the market for the beginnings of a new great swing. His judgment is clouded by his own insatiable greed. He has forgotten that the great profitable moves are rare. They are the exception, not the rule. He begins to treat the market like a personal ATM, believing he can withdraw a fortune from it whenever he pleases. The market will soon disabuse him of this notion. His entire tragic cycle was perfectly illustrated in Livermore's own career after his monumental success in the panic of 1907. He emerged from that crash a legend, the great bear of Wall Street, a multimillionaire who had proven his genius to the entire world. He was at the absolute peak of his powers and his confidence, and it was this very confidence, this hubris, that led him directly and swiftly to his next great ruin in the coffee market. He felt the need to conquer a new world, to prove that his genius was not confined to the stock market. He would become the cotton king. He began to build a position in cotton that was, by any rational standard, recklessly and dangerously large. He was no longer a speculator, carefully probing the market and managing his risk. He was a would-be emperor, attempting to corner a global commodity market through the sheer force of his own capital and his own will. He was not trading the market, he was trying to be the market. This brings us to another subtle and dangerous trap that is set by great success. A man of great fortune and great fame attracts the attention of other powerful men. He is invited into the inner circle, into the boardrooms and the private clubs. He is no longer a lone wolf, but a member of a prestigious pack. This can be a fatal development for a speculator. His great strength has always been his intellectual independence, his reliance on his own unfiltered reading of the tape. But now, his mind is exposed to the persuasive and authoritative opinions of other great men. This is precisely what happened to Livermore in the cotton market. He was seduced by the charismatic and powerful personality of the cotton expert, Percy Thomas. He allowed his own judgment to be subordinated to the grand vision of his new influential friend. The successful speculator begins to believe in the myth of his own genius, and this makes him uniquely vulnerable to the flattery and the grandiloquent plans of others who seem to be of his own stature. He has forgotten that on Wall Street there are no friends, only interests. The final and most insidious symptom of the seduction of success is a subtle perversion of the desire to win it back. This is not the familiar desire of a loser trying to recoup a loss. This is the desire of a winner who, after a long and triumphant advance, suffers a small, normal setback and reacts to it with a sense of personal affront. The speculator has built a massive position. The market has a natural, healthy reaction, and his enormous paper profit shrinks by a few percent. The amateur who has been humbled by failure might see this as a warning, a signal to take some profits off the table. But the man who has been intoxicated by his own success sees it differently. He feels that the market has stolen a piece of his new and glorious fortune. His ego is wounded. He is not driven by fear, but by a prideful and aggressive desire to not just win back that small lost ground, but to punish the market for its impertinence by winning even more. This is the psychological trigger for the most fatal of all mistakes. It is what causes a man to hold on to a normal reaction that is turning into a major reversal. It is what causes him to average down his winning position, a subtle but deadly error. It is the pride that comes before the fall. It is in these moments of dealing with the psychological pressures of a winning position that a speculator's character is most severely tested. The emotions after a great victory are, in many ways, far more dangerous than the emotions after a defeat. It is for this reason that a constant return to the first fundamental principles of the game is not a luxury for a speculator, but an absolute necessity for his survival. A return to this channel, to this video and others, especially in the euphoric aftermath of a successful trade, serves as a vital, cold water shock.
Hey traders, awesome to see you all here, and thanks for joining. Just an important announcement, this preview is delayed if you want to get access to the live features, so the live stream, the live commentary, access to our private Discord link chat, then use the link that we have in the description just under this video, guys. And also I would like to ask you all kindly to hit the like button, subscribe to the channel if you haven't done that already, and again I'll see you guys out there. Thank you.
Is clouded by ego, and his discipline has been relaxed. He is a giant with feet of clay. The market does not need to do anything extraordinary to destroy him. All that is required is for it to do what it always does, to fluctuate, to have a normal, healthy, and entirely predictable major reaction. But for the speculator who is now in this weakened and overextended state, this normal reaction is a catastrophic event. It triggers a margin call. It forces him to liquidate his massive position into a declining market, which accelerates the decline. The fall is always faster, more brutal, and more shocking than the long, slow climb. The fortune that took a year of brilliant speculation to build can be wiped out in a matter of days or weeks of undisciplined emotional trading. This, then, is the first half of the great lesson on the seduction of success. It is the diagnosis of the disease. It is the anatomy of how a great victory can become the direct and proximate cause for great defeat. Success is a more dangerous intoxicant than failure. Failure is a bitter tonic that teaches caution and humility. Success is a sweet poison that breeds arrogance, recklessness, and a fatal sense of infallibility. The emotional traps that are sprung by a great and triumphant win are the true and final enemies of the speculator. They are more dangerous than any bear raid or market panic, for they are an enemy that comes from within. The man who wishes to achieve a long and sustained career in the great game of speculation must learn not only how to make a great deal of money, he must learn the far more difficult and more important art of how to handle the psychological aftermath of having made it. If the seduction of a great success is the most subtle and dangerous poison on Wall Street, then the only antidote is a cold, hard, and deliberate dose of intellectual discipline. The speculator who has been fortunate enough to win a great campaign is now faced with his most difficult test. The market is no longer his primary adversary. The new enemy is his own triumphant and therefore dangerously unreliable mind. The professional understands this. He knows that the moment of his greatest victory is also the moment of his greatest vulnerability. He must therefore engage in a conscious and systematic process of self-control, a series of mental and practical actions designed to protect him from the intoxicating effects of his own success. This is the science of handling a fortune. This is not a matter of guesswork or of hoping for the best. It is a definite method, a set of principles as rigid and as necessary as the rules that guided his trading during the campaign itself. To abandon these principles at the moment of victory is to guarantee that the victory will be a temporary one. Let us then dissect this method. Let us examine the specific, practical, and psychological steps that a master speculator must take in the immediate aftermath of a great and profitable move. This is the art of not just making a fortune, but of keeping it. The first and most critical act that a wise speculator performs after closing out a major winning position is not to indulge in lavish celebration, but to conduct a cold and unemotional audit of the entire campaign. He must become a ruthless historian of his own success. He will take out his trading records, and he will study them with the same intensity with which he once studied the tape. He will ask a series of hard questions. What precisely did he do right? Was his timing at the pivotal point perfect, or was he a little early or late? Was his pyramiding strategy sound, or did he become too top-heavy at the end? He must also, with brutal honesty, analyze the role that luck played in his success. Was there a fortunate news event that accelerated his profits? Did he benefit from a market that was even stronger than he had anticipated? He must separate the results of his skill from the results of pure, dumb luck. This process of a post-victory audit is an act of profound and necessary humility. It is a deliberate exercise designed to counteract the ego-inflating effects of the win. It reinforces the critical understanding that his success was the result of following a sound method, not the result of some mystical inborn genius. The second act is the conscious and deliberate preservation of that humility. The speculator must constantly remind himself that the market is always the master, and he is and always will be its humble student. His great success was not a sign that he has conquered the market, but merely a sign that during that one campaign he was a very good and attentive student. To achieve this, he must engage in a form of mental counterbalancing. He must, in the midst of his great success, deliberately recall the memory of his past, painful failure. He must remember the times when he was wrong, when his judgment was flawed, when the market humbled him completely. He must study the history of the market and the lives of other great speculators, paying particular attention to the stories of their downfalls. He must see in the failures of others a cautionary tale for himself. This is not a morbid exercise, it is an act of profound realism. This practice keeps his mind grounded. It prevents the temporary feeling of infallibility from hardening into a permanent and dangerous state of arrogance. He knows that the market is always waiting to humble the man who has forgotten his place in the great scheme of things. The third act, which flows directly from the first two, is the immediate and fervent reinforcement of his own trading rules. The amateur, flushed with victory, believes he has transcended the need for rules. The professional knows that this is the moment when the rules are more important than ever. The speculator who has just won a great fortune must, at that very moment, take out his written list of principles, his rules for risk management, for position sizing, for entries and exits, and he must read them as if for the first time. He must make a new and solemn vow to himself that he will adhere to these rules on his very next trade with the same rigid discipline he used when he was starting out with a small and precious stake. He must commit to treating his next opportunity as if it were his first. This is a powerful act of mental discipline. It is a recognition that the principles of sound speculation are universal and unchanging. They apply to the man with $10 million, just as they apply to the man with 10,000. To believe oneself exempt from these laws is the very definition of a fool. The fourth act is a practical one, concerning the management of the new, larger capital base. A great profit brings with it a great new responsibility. The speculator's capital has now grown, and he must adjust his thinking accordingly. The amateur, having turned $10,000 into $100,000, may see this new fortune as house money. He may feel that it is money he can afford to be reckless with, to gamble on the long shot. This is a fatal error in thinking. The professional understands that there is no such thing as house money. It is all his capital. The new, larger fortune must be treated with even more reverence and respect than the original, smaller stake. For it is the fruit of a successful campaign, and it is the ammunition for all his future operations. He must adjust his risk calculations accordingly. He must understand that a 10% loss on a $1 million position is a far more serious and psychologically damaging event than a 10% loss on a $10,000 position. The stakes are now higher, and his caution must be greater. His position sizing must be recalibrated to his new capital level. but the underlying principles of risking only a small fraction of his total worth on any single idea must be maintained with even greater rigor. The larger the fortune, the more conservative a man must become in its management. The fifth, and perhaps most important practical act after a long and grueling campaign, is the strategic withdrawal. The wise speculator, having closed out his great position and converted his paper profit into cold hard cash, does not immediately look at the next trade. He does the opposite. He gets up from the desk and he walks away from the game entirely. He takes a vacation, he goes fishing, he travels, he does anything and everything that is completely unrelated to the stock market. He forces himself into a period of quiet, restorative inactivity. The purpose of this is to allow the mental and emotional intoxication of the great victory to fade. The human nervous system is not designed to exist in a permanent state of high stakes, high adrenaline excitement. It must be given time to rest, to clear, and to return to a state of calm, objective normalcy. To remain in the market in the immediate aftermath of a great win is to guarantee a reckless, emotional, and almost certainly losing trade. The speculator is, in that state, not operating with his intellect, but with his overinflated ego. He must wait for his head to clear. This strategic withdrawal is an act of profound self-knowledge. It is a recognition that a man's own triumphant emotions are, at that moment, his greatest and most dangerous enemy. The sixth act occurs when the speculator, his mind now clear and his nerves settled, finally decides to return to the market. He does not return with a great and dramatic flourish, with a massive bet designed to prove that his genius is still intact. His very first trade, even as a multi-millionaire, must be the same as it was when he was a novice with a tiny stake. It must be a small, cautious, and exploratory probe. This is the ultimate test of his discipline, the final proof that he has not been permanently corrupted by his own success. It is an act of profound humility. He is once again a humble student, asking the market a quiet question, not a master shouting a command. He waits for the market to give him a clear signal at a pivotal point. He makes his small test trade. He waits for the market to confirm his judgment of the profit. He is following the same methodical scientific process that he has always followed. He has returned to the fundamentals. By starting small again, he re-engages with the market from a position of mental and financial safety. If his first few trades back are small losses, they are of no consequence to his great fortune. They are simply the market's way of telling him that the time is not yet right. The seventh act of discipline is the resistance to the temptation of new and unfamiliar fields. A man who has achieved a great success in the stock market often begins to believe that his genius is universal. He is seduced by the idea that he can apply his Midas touch to other, more glamorous ventures. He will be tempted to take his speculative winnings and invest them in real estate, in venture capital, in oil exploration, or in the manufacturing of a new invention. This is a classic and often fatal error. The principles of success in one field do not automatically translate to another. The world is filled with the stories of brilliant stock speculators who lost their entire fortune by venturing into businesses that they did not understand. The professional, having won the game he has mastered, has the wisdom to stick to that game. He knows where his expertise lies. He does not allow his ego to convince him that he is a universal genius. He respects the specialized knowledge that is required for success in any field. The eighth act is the battle against the great and terrible enemy that often follows a major success: boredom. The thrill of the great campaign is over. The market itself may enter a dull, listless, sideways period where no clear opportunities exist. The undisciplined speculator, now a man of great wealth and with a mind that is addicted to excitement, finds this state of quietude to be unbearable. He craves the old thrill, and so he will begin to force the action. He will make foolish trades in a dead market, not for the profit, but for the gamble, for the simple desire to feel something. He will invent opportunities where none exist. This is the path back to ruin. A slow bleed of capital caused by a lack of emotional control. The professional, by contrast, accepts the periods of dullness as a necessary and even welcome part of the market.
All right. I come back, Ken.
Patiently in cash.
Hello, sir. 3D next week. Yes.
His mind and to wait.
So what your question, Ken?
He knows that he is not paid to be entertained. He is paid to be right.
Look at that. I said $8, right? It takes forever, right? But the power lunch, it break. It's called BBS setup. It hold right here to be well. Can go higher. That's all.
The speculator is not the accumulation of the great fortune. That is merely the scoreboard.
Discipline, sir. Discipline, discipline, baby.
Not just financially, but psychologically.
Okay. No FOMO.
The ability to handle a great and triumphant success without.
All right, here. Let me write out some note right
It
here.
is the victory of character.
Waiting
It
is
is the discipline.
discipline.
It is the quiet and often lonely work of
Okay, waiting does discipline.
a world that is calling you a master.
And C.
The speculator
C, that means using your eye,
who has created a definite method for managing not just his capital but also his own triumphant
Not
human nature is the one who has achieved
your
the
thinking.
most difficult level of change. He has conquered not just the market, but the far more treacherous and unpredictable
Right.
landscape of his own mind.
right here, guy.
He has learned that failure is a teacher, but that success is a test.
All right here.
And it is by far the harder one to pass.
Waiting is discipline. And C, that means using your eye, not your thinking.
The amateur, the hopeful gambler,
Okay.
comes to Wall
No
Street
FOMO too.
consumed by a single
All right, here the palm with you can hear your palm right here.
how much money can I make? He is a hunter of gains. a
Here the
dealer of
palm.
fortunes, and he is
DBGI,
mindset.
one breakout, you FOMO.
Speculator,
Okay?
the man who has survived the
Okay,
unforgiving
all right, look at this one.
long enough to learn its great
Here the palm.
universal laws, begins from the polar opposite.
Here the palm, guy.
His first, his last, and his most obsessive thought is not on the potential reward, but on the
Here the palm.
ever-threatening reality of risk. His
All right, over here you see palm up,
how much
you FOMO, right?
to lose.
You just
The
wait.
great fundamental
And then you see the pullback right here, wait and see. Right here, pull back. Why here?
The amateur is an optimist.
Why here? Question mark.
The professional is a real.
Because over here, buy a step in.
And most sacred duty is
Okay, buy a step in.
discipline, preservation.
And then when you see right here, break right here,
Simple and profound truth.
you can buy some right here,
Without capital is like a
small side.
army.
Then you can S on right here, S on, add on,
His opinions, no matter
add
how
on,
good, are worthless.
sell.
His past victories are but memories.
Alright? Because right here, because if you lost, you wrong, you get out right here.
Against the market.
That's why I like right here. Okay?
To understand the operational philosophy of
Alright? And then when it pump, you sell, you're waiting again. Okay, waiting. Buy a step in right here. You see that?
was built upon this
You wait and see right here.
foundational bedrock.
You can jump in right here.
Above all else.
You don't jump in right here, okay?
Merely a rule.
That's selling right there. You jump in right here.
This
You S on,
forged through
double top, you sell right here.
victories and soul
See that?
is a science.
Makes sense, right?
It is a set of definite,
Okay, here one more.
inviolable laws.
You pick the good stuff, but you got the wrong time, guy. Wrong.
There's only truth.
FDA right here. You see? Pump.
The principles that form this shield were documented with
Okay, right here.
and insight by Edwin Lefebvre.
You buy too late because when you see it, they're already late.
A link to his essential work, reminiscences of a stock operator.
Okay,
Now with
right here,
detailed
it pump right here already.
from Max Davidson. His
Pump right here, you late, you FOMO. You jump in right here, you wrong. That's all.
is specially designed
Okay?
for the timeless
You
wisdom
pump,
of
when you see here,
the market.
over here you see FOMO.
With that, let us begin the clinical dissection of the 12
Okay?
principles
Usually FOMO.
that form the core.
Market open, jump. Right here, you jump in right here, you wrong, get out right here. You know where to get out before you get in.
The great law.
And then more plus.
of the derived.
One more thing,
The alpha and the
sell right
omega
here. That's it. Let it run. Who cares?
The first goal is not to
All right, one more.
but to survive. The
What
first
else?
victory is not a great
TEL.
but the simple act
Nothing.
to come back and play.
Look at this one. When it pump, you FOMO.
Capital is his inventory.
It makes sense? Right now, good. The VWAP right here. But the problem, no volume. No volume, no trade, guys. No volume, no trade.
Allow the market, through his own carelessness,
No volume, no trade, guys. That's it.
steal his precious capital. The man who does not
This morning, I got in this one right here. And this one killing me, this one.
gambler, a thrill
I got small size.
certain path
I jump out.
to oblivion. He treats
All right,
the
here
market
this
like a
morning.
casino going forward on a single
Morning, I jump in right here.
speculation as a serious business.
9:17.
Rule of any business
I get out almost $8 right here. Under 8, I get out.
protecting one's
Look at this one.
capital with the ferocity of a mother.
Right here.
Young. Every decision, every trade, every thought must first pass through this one simple filter.
Right here, guys. Look at this one.
Does this action increase?
If I don't jump out, I'm underwater a lot.
If the risk is too great, if the conditions are unclear, if the odds are not
Right
in
here.
one's favor,
When the curve break out, I jump in. When all the time, market open usually go down. 99% go down when the market
his job is
open.
to ensure that he is still there.
Okay, I jump out right here, guys.
This requires a defensive
You have to.
mindset.
I know go down right there. I say, yes, I'm out.
Offense, always trying to score.
I'm out right there, guys. Perfect.
Spends 90% of his time on defense, on studying the field.
I almost sell right here, but it goes so fast. Look at it. 1, 2, 3 candle all the way down. When it go down here, 820, I say, yes, I'm out here.
And made
Look at
the
that.
position
Boom, all the way.
strength. Capital preservation is not a timid strategy. It is the ultimate expression of speculative courage.
See?
It is the courage to be patient.
Not get out right there.
And the courage to admit.
But this one good right here.
It is the foundation of a long and prosperous career.
520, get out 620.
Primary practical
Crazy,
application
right
of the
there.
prime directive. If the first rule is to preserve capital, then the first action must be the swift and merciless cutting.
Right here, this morning.
A loss is a
Look, hold the reware right there. See, I draw the line, it's working, guys. It's stuck right here. Buy a step in, it break here, go all the way back to a 620.
Final arbiter of truth. A loss is not an opinion. It is a fact.
I don't know nothing.
It is the market.
The problem I know in the market, I know the chart.
The speculator's initial judgment.
I don't need to know nothing. I need the chart tell me what to do. I need this one right here,
He
guys.
obeys it instantly and with
I know the volume. Look right here, the volume. This is a good time to get in. This is a good time to get in. That's it. You see right here? A flush setup right here. A flush setup. No volume, pump. Look, boom. See? Right here, boom. You see that?
He is a man whispering comforting lies to himself.
Watching the volume, that's all.
A small loss when taken quickly is a
Volume, guys, volume. No volume, no trade.
It is a normal business expense. A small insurance premium paid to the market for the privilege of testing a speculative idea.
Yep, you trade that stuff yesterday.
That feels overnight.
You have to tell me what the price too.
Is allowed to test it.
All right, this one right there holding.
Day by day.
It break, hold on the VWAP.
Ultimately,
At power lunge, start to curve back up, the volume increase. That's the A flush. If not, don't touch it. This is the backside.
for all future decisions.
That's the backside right now.
Take a small loss with a sense of professional pride.
No short, no squeeze, guys.
Failure as
The squeeze because it's short. Right here, look at it here. A flush setup, guys.
it is the proof that he is following his rules. The human
Discipline.
ego is the great enemy.
Discipline the best.
The ego hates to be wrong. The act of selling for a loss is
Right there, nice support right there, 620.
a painful blow to one's pride. The amateur would rather risk a great deal of his money than a small bruise to his ego. The professional has learned through painful experience that his ego is a luxury
620, baby.
He has subordinated his pride to the simple, profitable mathematics of risk management. He knows that his job is not to be right all the time, but to make
This is a crazy one right here. SOG, be careful this one. This one have no volume, but crazy. You see right here, draw a line right there.
This is the speculator's mortal sin. It is
Fighting short.
illogical.
Hit 15 support.
All trading mistakes. It is the act of not only failing to
Crazy,
perform,
crazy.
but actively and deliberately reinforcing.
This is a crazy one too. Look at it.
The amateur trapped in a losing position by his ego. And
Look at that guy. Up almost 230%.
as an opportunity. He tells himself, the stock was a bargain at 50.
Yep, everything can happen.
Better bargain at 40. He buys
The short
more,
cover.
averaging down his cost. He believes he's being a shrewd investor. In reality, he is a fool, doubling down on an error in judgment.
So what error
He's
can?
throwing good money after bad, sending his precious reserves into a battle that is already being lost.
No more moving right now.
Operates on the exact
This
course
one crazy. This one right here, guys.
reinforces failure.
This one yesterday I sell 1170 yesterday.
He pyramids of profit.
I sell right here.
To make more capital
Look,
position that the market
he tried to curve back up. It's not curving. And then before the market closed, look at pump.
It is an act
Man.
costly arrogance.
How do you
The
know?
stock is not cheap.
Nobody know.
It is weaker.
You just react only, guys. Nobody know, okay?
At least resistance is
Nobody know.
To buy more of it is to attempt to catch a fall.
Nobody know this one.
This mistake is born of the desperate.
But I know when the rate 14 go higher.
The trader, by lowering his average cost, believes he is making it easier for the stock
Right
to
here.
come back to his break-even.
Nobody know this one right here.
He does not realize he is only digging his financial grave.
If it pump like this, I sell almost right here. Take profit right there. Small side yesterday. Look at it, pump. It's always do like this, crazy. But this one $14, guys. You need to hold 14.
To do otherwise is to violate the most fundamental principle of
You
capital.
need to hold 14. Look at this.
It is the act of a man who, finding himself
Alright,
in a hole,
look at this one. 20 day.
decides that the only solution
20 days ago, from $1 go to 90,
let profits
85.
This is the great positive corollary to the
This one can run. If they have some good news,
The
it pump.
speculator who has mastered the
It
art of
form.
cutting his losses has solved
How about this one? QMMM.
Near survival to great fortune, he must master the second.
Look at QMMM, guy. Hold on. $100, 110.
Run. The same emotional demons that cause the amateur
Yep.
to hold his losers cause him to sell his winners too
Yeah.
soon. He enters a trend.
All right. Okay, let's see read, guys.
and profit. Immediately he is seized by the emotional fear.
Read right here.
Seeing that paper of profit disappear.
You stuck right here, right?
He's
Read.
tormented by the thought of a normal reaction wiping out his game. He tells himself the most dangerous.
Read right here. You see it go down, right? You short right here.
You can't go broke taking it.
And look at gap up. Crazy, guys.
And so he sells, snatching his small, nervous gain.
So you short right here. That's a nice bear flush. You never know, right?
That guarantees a man.
That's a bear flush right there.
His career becomes a series of.
I said $30.
And mathematically wiped
When I
out
see this, I said $30.
losses that he
This day right here, I said 30. Rate 30 go down to 20.
that it was never his thinking that
Break 20.
for him
Right here, I
was
think.
sitting.
This day right here,
And the character
30.
hold a winning position
Break down
day
20.
after day, week after week.
And then after that, all the way to 12. Crazy guy. All right.
Profits are not made
This
in
one
the
go.
great-
If this one break right here,
made in the great
let's see what's going on.
nerve-wracking middle of the big
You
swing.
never know, guy. You never know. Everything can happen.
Burned up trend.
25.
Imagine a victorious campaign long before the final victory has been achieved.
25. Look at
The
that.
speculator must have the patience to sit with a winner.
Try break right there and see what happened.
Pull back, and to give the trend the time it needs to fully mature. This is the hardest work in speculation. It is a battle against the
Yep.
final instinct for a small gain.
QMMM, you try dumb, you jump in, you done, you burn.
Man who can turn a 10-point gain into a 100-point
You burn,
gain.
guy.
He is the one who captures.
Never go down, guy. Look at that. Nothing go down.
There's only a few times a year.
Crazy.
He is a farmer
Seriously?
who has patience to let his crop grow to its full and magnificent harvest.
You think right here, you get in right here. Is that right?
Overtrade. This is a rule against the gambler.
Even 5 minutes don't see it.
The amateur
even
trader
5 minutes don't
is
see it, guys.
to be missing an opportunity. He cannot stand the quiet of being in cash. He feels a compulsive need to always have a position on, to always be
Yeah.
in the game.
If this one break 120,
And it leads to the destructive.
and then 150, You see, go back up here, guys. It never happened, but you never say never.
Speculating on the great primary
You
trend.
never say never, right?
On the random day-to-day.
Consolidate.
The costs of this habit are twofold. The first is financial.
Consolidate, huh?
Buying at the top with a small wiggle and selling at the bottom. His account is steadily bled dry by 1,000 small losses and the constant corrosive drip of commission. The second cost.
Consolidate. That's what you
The
say.
man who is always in the market is the man whose mind is never clear. He is in a constant state of emotional turmoil, his judgment clouded by the stress and the anxiety of his last losing trade. He loses his perspective. Livermore knew that the most profitable position in the market is often no position at all. There are long periods when the market has no clear, definite trend. To trade during these times of
Look at this one, guy. I find out this is a B one. Look at this.
the professional speculator,
It's going all the way up. Mining.
but also his precious
Barrick mining.
capital.
Bitcoin mining,
He
right?
knows that his judgment is his greatest asset.
This one now.
Awesome to
This one is
yeah, thanks for joining. Just an
gold mining. Look at gold mining, guy.
is delayed if you want to get access.
Crazy,
to
huh?
live features, so the live
Gold mining.
access to
Go higher. Straight up.
This will go in chat.
He is
That
paid
is the
not for
link
his
that we
actions,
have
but
in the
for his
description, just under this video. Guys. And also,
All right, this is a crazy one. The day before, I get in $7. I sell $7.50. This one.
risk only a small fraction of capital to trade.
Look at this one, guy.
Mathematics.
This morning I tried to buy $1 and see what happened. It not go down, it not go up. Look at it.
All the others together.
Look at this one. $7, $7.50.
The amateur, when
2 days ago, it pumped.
information about a particular trade,
It
is
pump, pump, pump.
bet the farm.
You see?
He will risk the
From
loss.
$3 pump all the way to 7. Look at that.
10, 20,
I got no news. I don't know what's going on. See, no
The
news.
man who's playing
Look at that
the
guy.
game of his own career.
And then I see it pump, dump, 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 dump. Crazy. How can it happen like that?
Completely and permanently.
That's called IMPP.
Speculator, no matter how confident he is in a particular trade, will never
IMPP, baby.
risk a large fraction of his total capital on a single
Right now, 72 cents not going down.
Position sizing is a matter of
The problem, you buy cheap, cheap.
arithmetic.
You buy cheap, that's the problem, guys.
Stop-loss rule.
You got cheaper.
First layer of this.
You never say cheap.
Formula goes deeper.
You never say cheap.
Potential loss from that 10%
You think it go back up.
represent only
That's what you think. But the chart say no.
speculators
It's
will
cheaper.
pay. A sound rule is
You
never
see it
more than
cheap,
1 or 2%
and then you
of
change late,
on a single
you say it will go up again.
This
That's
is
the problem, guy.
guarantee of survival.
You never say go up. It's so cheap.
Who follows this rule can be wrong 10 times in a row.
Your eyes see it go down.
Lost 10 or 20%.
You think it go up.
He is still in the game.
That's why people buying. How? It go down,
The
see?
amateur who was wrong just
It go down, how can you think it go up?
the business forever.
If you use your eye
Who is the source of
and
truth?
control your subconscious,
A man
you will see it go
maximum
down.
possible loss from any single trade is a small and manageable
Okay?
amount.
When it go down,
Trade without fear.
don't think nothing. Use your subconscious.
The anxiety that comes from having too much.
Control your subconscious. Your subconscious say go up.
The decision based
Anytime it go up, you think it go down, okay?
on a desperate need to protect himself.
For example, this one right here go up.
It is in these
Go up this morning, you think it go down, that's all.
But the true work of the speculator.
When right here, boom, 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 you worry, you fear.
Desire to bet big is a powerful enemy.
Over here,
It is for this reason
you
that
think, right here.
first principles
You thinking.
are
At this time, it's fear.
to this video and others, especially
Fear.
after a series of painful losses has clouded one's judgment.
And then you think it go down.
This is a vital recalibration of the
Think fear. Why you fear?
The science of position sizing is the final and most important element of a sound defensive strategy.
It's will going down.
Masters it has made it mathematically impossible for the market to ever.
Because in your trading time, you see it happen all the time. But this time right here,
The most important victory.
in this time right here, you will think it going down. You think, right?
The great game of speculation
Right here,
is not
guy.
a game of action, but a game of reaction. The amateur, driven by his impatience and his greed, is always trying to make something happen. He seeks to impose his will upon the market.
Yep, right
The
here.
professional knows this is a fool's errand. He waits with the calm vigilance of a master for the market itself to give the signal. A speculator is not paid to be a fortune teller.
Yep.
He is not paid to anticipate, to guess, or to hope what a stock will do. He is paid to correctly diagnose the present fact of the market's action and to act upon it with intelligence and dispatch. To act before the market has spoken is to be a gambler, betting on a blind turn of a card.
Yep.
The clear market signal, the one that justifies the risk of one's capital, is the breakout at a pivotal point. This is the moment when a stock, after a period of consolidation, decisively announces its intention to begin a new and powerful move. This is the moment when the line of least resistance becomes clear and unmistakable. This signal must have a definite character. It must be a move of authority, a breakout with power and force, and it must, without exception, be accompanied by a dramatic and significant increase in the volume of trading. This is the market's own confirmation that the move is genuine and is being sponsored by the smart money. To buy before this pivotal point is to act on hope. To buy after this pivotal point has been confirmed by the tape is to act on evidence. The entire science of speculation can be reduced to this simple distinction. The professional waits for the evidence. He may have to wait for days, for weeks, or even for months. It does not matter. He has the discipline to sit with his capital and his peace of mind intact until the one
If you hold 1,000 share right here up,
presents itself.
you
The
fear.
market is not a continuous performance. It is a series of rare and valuable opportunities. The speculator's job is to be ready for them. To act without a clear signal from the
You guys see
is a
that?
sucker.
When it go up right here, you fear. You selling. You sell too early. You sell right here.
8. Cash.
That's why I hit the bell. I said, don't worry. I see it go up. So relax.
Is to be a speculator.
Then you can sell some right here.
Is to be a failure.
Right here.
He feels
I hit the bell like this.
nervous to be invested, to have a position on. To be in cash to him feels like an admission of defeat.
When I fear, I hit the bell.
This
I
is a
say,
profound and costly
be
psychological
careful. Your subconscious are fear right
The
now.
speculator understands the truth
To
that
protect
is
you, the
invisible to
subcontract
market.
try,
The cash
conscious
position is
try
often the
to
most strategic,
protect
the most
you.
powerful, and the most profitable.
At that time, make you fear. Why you
To be in
fear?
cash is not to
You
be out of
but
the
be
game.
hopeful.
It is to
Okay?
be a king in reserve.
You don't fear at that time. You hopeful. You ask on. You try to ask on to 1 share, 2 share.
The man who is
To
in cash
practice
possesses
your
an asset
good
of
habit.
incalculable value, a
Right-
clear and objective
Right here. If you
mind.
buy a lot right
He is
here,
not emotionally entangled in
when
any
it starts to
particular stock.
curve back up,
He is not being whipsawed
you
by
ask
the
on.
market's minor
you don't
fluctuations.
selling.
He is not
You add on right here. Sell some right here.
Small,
Okay?
frustrating losses. He can sit and observe the market.
Over here, see, you ask on right here, ask on sell.
He can see the great primary trends forming without the distorting lens of his own hopes and fears. His judgment is sound. His mind is at peace.
Look here, my trend line still working right here. See, I just adjust right now. See this one right here, I got the line.
By his last trade.
Right now, maybe I
He is
adjust a
either
little bit.
overconfident from a small
Right there.
win or
You look at this
fearful from a
one.
small loss.
This one, look exactly, look,
He cannot
guys,
see
look
the
at it.
forest for the trees.
I don't know why, but that's the way I draw.
When the conditions are
I can
not
tell
clear.
the market how it
When the tape is
react
telling a
right
story
there.
of confusion and indecision. These are the
And I just
treacherous
adjust
sides
this
of the market.
because you have to adjust the market
The
moving. You have to
professional
adjust
speculator knows
slightly.
that to trade in such a
Right
market
there.
is to engage in a low probability gamble. His response is simple. He does nothing. He sells his positions, converts his assets to cash, and he waits. He preserves his capital, and more importantly, he preserves his mental and emotional energy. He knows that his job during these times is to study the market, not to trade it.
Right here, look.
To be in cash
Just
is to be the master of your own destiny.
This one need
You
to
are
break
not at the mercy
820.
of a sudden overnight news event. You are not a prisoner of your own positions. You are a free agent with your capital intact, ready to strike with overwhelming force when the one true and unmistakable opportunity finally presents itself. 9. Never trust tips or other people's opinions.
Yep.
The speculator who would succeed must learn to stand alone. He must be a lone wolf, doing his own thinking, forming his own conclusions, and acting upon his own judgment. The moment he allows the opinion of another man to influence his
All right, this one Powell, this one guy,
surrendered his
this
own
one
mind,
Powell right
his
here.
capital is sure to follow.
Ed
The
Pawn.
world of Wall Street is a vast and noisy echo chamber of tips, of rumors, of so-called inside information. This is the bait for the sucker.
Look, Ed
The
Pawn guy,
amateur, in his
Powell,
intellectual laziness and his desire for a shortcut to
Right
easy
here.
money, is an insatiable
$2.
consumer of these tips.
this one hold right here, the VWAP right here, guys. Look at the VWAP. Way easier. Happens with VWAP all the time. When I draw the line, I draw right here,
He does not see that a genuine tip is the
Two.
rarest thing in the world,
and the VWAP.
and that the vast majority of
And the
what he
support
hears is
right
either
here.
a guess, a hope, or a deliberate piece of manipulative propaganda. To act on a tip
Just
is
wait
to make
for a
a trade
volume.
for which you do not understand the premise. You do not know the real reason for buying, and therefore you will never know the real reason for selling. You are a blind man being led by another, and both are destined for the dip. Livermore learned this lesson in the most brutal way possible. In the great cotton debacle, where he lost a fortune by subordinating his own judgment to that of the expert, Percy Thomas. He had seen the sell signal on the tape. His own proven method was screaming at him to get out. But he listened to the persuasive, hopeful words of another man. It was a mistake that cost him everything. From that day forward, the rule was absolute. He did his own work. He studied his own charts. He read his own tape. His mind was a locked room, and the opinions of other men were not granted entry. The speculator must learn that no man can make a great fortune by having another man tell him what to do. The thinking must be his own. The decisions must be his own. And the responsibility for both the profits and the losses must be his own. 10. Patience is protection. The virtue of patience is not, as the amateur believes, a passive quality. It is an active and powerful form of defense. It is the speculator's primary shield against the two things that are most certain to destroy him: his own emotional impulses and the market's many deceptions. Patience is the discipline to wait, motionless, for the one true high probability setup. It is the refusal to be lured into the market by the siren song of small, meaningless fluctuations. It is the wisdom to know that the money is made not in the trading, but in the waiting. Patience is the protection against the whipsaw of a sideways market. The impatient trader is chopped to pieces, his capital bled dry by 1,000 small cuts. The patient trader stands aside in cash, his capital preserved, and waits for the trend to declare itself. Patience is the protection against chasing a stock that has already had a great and powerful advance. The impatient trader, driven by a fear of missing out, will rush in at the top, just as the smart money is beginning to sell. The patient trader will let the stock go, knowing that to buy late is to buy wrong. He understands a simple truth. The market is a continuous parade of opportunities. To miss one is of no consequence, for another will soon come along. There is no need to be in every move. There is only a need to be in the right moves. Patience is also the courage to sit tight with a winning position. It is the discipline to not be shaken out by the normal, healthy reactions that are a part of every great trend. It is the fortitude to let a profit run, to allow a 10-point gain to become a 100-point gain. The speculator in the end is paid for his patience. He is paid for his patience in waiting for the correct entry. And he is paid for his patience in waiting for the correct exit. Every other action in between is a potential source of loss. 11. The market is always right. A speculator is a man who deals in opinions. He forms an opinion based on his study about the future direction of a stock or the market. But he must never, for a single moment, forget this one supreme and humbling truth. His opinion is worthless until it is confirmed by the market itself. The ticker tape is the final arbiter. It is the Supreme Court. Its verdict is the only one that matters. The speculator who begins to believe that his own opinion is more important than the market's action is a speculator who is on the verge of a great and devastating ruin. This is the very essence of the ego trap. The amateur, when a trade goes against him, is often heard to say, "The market is wrong. This stock should be going up." This is a statement of profound and dangerous insanity. The market can never be wrong. It is the sum of all forces, all knowledge, and all opinions. It simply is. The speculator's opinion, on the other hand, can be, and very often is, wrong. The entire business of risk management is built upon this simple acknowledgement of one's own fallibility. The stop loss is the practical mechanism for enforcing this principle. It is the pre-committed decision to accept the market's verdict without argument. When a stock moves against a speculator and hits his stop, the market is saying, "Your opinion is wrong." The speculator's only sane response is to say, "I accept your verdict," and to close the position. To argue with the tape, to hold a losing position in the face of the market's contrary evidence, is the act of a man whose pride has become more important to him than his capital. And the market has a way of taking both from such a man. 12. Control emotions. This is the final and the all-encompassing law. It is the one principle that makes all the other 11 possible. The speculator who has not first learned to control himself can never hope to control his account. The great battle is not fought on the exchange. It is fought within the mind. The market is a machine that is designed to exploit the most powerful and primitive of human emotions. It tempts a man with greed. It paralyzes him with fear. It deludes him with hope. It inflames him with ego. These are the great enemies of the speculator. The entire set of rules and principles that Livermore developed was, in the final analysis, a system for the management and control of these emotions. It was a scientific fortress, built to protect his rational, analytical mind from the destructive chaos of his own human nature. The stop loss is a rule against hope. The practice of patience is a rule against greed and impatience. The principle of following the trend is a rule against ego. Each rule is a specific and targeted defense against a specific emotional weakness. The speculator who would succeed must become a cold and detached operator. He must learn to view the market not as an exciting casino or a personal antagonist, but as a series of impersonal mathematical problems to be solved.
All right, power lunch guy. I need to have dinner, lunch right now.
Without flinching and a great profit.
Look at Ling, 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 Ling. Ling moving. What the heck is Ling
An
moving?
observer of fact, not a participant in a great emotional drama.
Watch out this one. What's going on?
It is a lifelong and never-ending battle against the powerful currents.
FOMO right now.
But it is the one battle that must be won. For the speculator who has achieved the
FOMO,
emotional control is a speculator who has at last become invincible.
350. Right there. FOMO guy, $3 resistance.
Get up high quality that's guaranteed fresh and down low prices that are lower than low.
Alright guys, I'm done. See you guys later. Bye bye.